Welcome to the European Market Open. A minute to go until the start of cash equity trading. I'm Tom McKenzie. Broad-based bearishness, Asian stocks and futures kick off the week on the back foot after strong US jobs data solidified bets on another jumbo rate hike from the Fed. Golden Week tarnished, Chinese markets reopened in the red, weighed down by concerns over global interest rates, COVID, and fresh US curbs on technology. Plus, Vladimir Putin accuses Ukraine of carrying out Saturday's attack on a key bridge linking Russia to Crimea. And of course, in the latest developments there, just in the last few minutes, you have had reports of explosions in the Ukrainian capital of Kyiv, and we'll keep across that story for you. Let's take a look at the futures then, pointing lower by 1.2% after the bloodletting towards the end of the week. The volatility in these markets, of course, focused on these data points. At the beginning of the week, the expectation that maybe you'd start to get a pivot from central banks, that was put to one side when you saw the strength once again of the US jobs market, and unemployment rate back to a level, record level of 3.5%. And again, baking in 75 basis points. That is the consensus view of the Fed come November. The Spanish IBEX currently down 0.6%. Here in the UK, the FTSE 100 down 28 points as the BOE steps in, again, just a few minutes ago, saying they will continue to provide liquidity within the gilt market as they look to the end of those operations on October the 14th. Over in France, you're looking at losses now of more than 1%. Let's switch it over and see how things are looking on a big week as well for earnings. You've got the big banks, stateside, JP Morgan, Morgan Stanley, Citi, BlackRock as well, the money manager, of course, coming out with their earnings, and a view as well that Apple is going to be consequential in terms of the earnings picture there in terms of filling out the expectations around growth, demand and supply chains, and of course the question around inflation. Future stateside looking to further losses of 0.6%, of course, after the very heavy selling we saw on Friday, again on the back of that jobs report. The pound at 110, just down 0.1%, and the 2-year here in the UK 4.15, again continuing to watch the gilt space on the back of the action from the BOE, trying to calm these markets again, saying they will step in with additional liquidity if and when needed. $97 a barrel on Brent, coming off by 0.3% after, of course, that deep cut in production from OPEC. The concerns once again back on the growth picture when it comes to the oil story. Now, stocks are lower this morning as investors worry about rising interest rates. That's after a strong US jobs report, as I mentioned, reaffirming those bets of a jumbo Fed hike in November. Allianz Chief Economic Advisor Mohamed El-Erian said the US economy is on a bumpy journey to a better destination, but that the risk of recession persists.
Not only does it have to overcome inflation, but it has to restore its credibility. So yes, I fear that we risk a very high probability of a damaging recession that was totally avoidable.
Okay, that was, of course, Mohamed El-Erian, formerly of PIMCO. Joining us now for more is Sharon Bell, Goldman Sachs co-head of EMEA Investment Research. Sharon, let's just get your views then on the tightness in this job market, what it means for the Fed going forward. The MLive question of the day is how many more 75 basis point jumbo hikes can we now expect from the Fed? Is 75 baked in for you for November, and do we get more in December as well?
Yeah, I think we get 75 in November. I think we get more in December and probably another hike after that early next year. So I think we've got more hikes to come. Inflation remains sticky and high. The jobs market, yes, it's slowed a tiny bit. That's quite clear, but it's still not slow to the pace that you would need to really see wage growth come down to make inflation more sustainable.
Could we get into a world where, in fact, the job market remains robust, but inflation broadly comes down, or are those two things totally incompatible?
I do think there are some sort of high-frequency indicators that suggest inflation might be peaking and coming down. Things like freight rates have come down, a lot of commodity prices have come down, although OPEC's recent moves will probably push them back up again a little bit. So some prices have definitely come down. But I do believe, and certainly the central banks believe, which is more important, that wage growth coming down is an important part of the mix.
Okay, so you do need that wage growth to come down. It came in pretty solid again on Friday, didn't it? In terms of just their trajectory then, you see 75 basis points in November, further hikes in December, and possibly one in the new year as well. Do we get to a point where something breaks before the Fed gets inflation back to, if not to 2%, then something that looks and feels a little more comfortable?
Yeah, I mean, this is clearly what the market is worried about, the volatility recently. You mentioned the volatility. Every day we're coming in and we're either up 1% or down 1%, off and down. So the volatility, you've seen the volatility in the gilt market. That clearly was a situation where higher rates or concerns about higher rates caused volatility and problems in that market. So, and debt levels across the economy are relatively high. So all of those things mean that, yes, there is fragility there, and this is one of the things markets are worried about.
And fragility brings us on to the question of the fragility that we're seeing here in the UK markets, of course, the BOE coming in with a statement. I'm looking at gilts not moving a lot today after they reiterated their determination to ensure there's adequate liquidity. Is the BOE backstop enough for gilts at this point?
Yeah, I think it probably is enough for gilts. I think that it's almost a kind of they'll do whatever it takes period of time. The Bank of England clearly want to stabilise that market, and I think that they did stabilise the market, and they haven't needed to buy all that much in order to stabilise the market so far. But obviously there's a lot of moving parts here. We don't know what's going to happen to gas prices. That's really important for the gilt market now, given that the UK government have capped gas prices for households. So they've kind of made the gilt market linked in some ways to gas prices. If we have a mild winter or a moderate winter, not a really severe one, probably there won't be a big concern for gilts. But if the winter is much cooler, gas prices spike up, for example, that's going to create more concern there.
That's really interesting, the linkages between gas prices and gilts, and we'll continue to watch that then, given that you flagged that. In terms of UK equities, talk to us about the relative outperformance of UK equities and the role of buybacks and how supportive you think that could be. Corporate buybacks, even as foreign flows start to reduce, in terms of supporting UK equities in the months and quarters ahead.
Absolutely. I mean, I think we've seen it this year so clearly. The UK market's been one of the best performers this year. The FTSE 100 anyway, the big cap stocks, not the mid cap companies which are more exposed to domestic growth, but the FTSE 100, huge international index. Obviously, it benefits from that strong dollar because a lot of earnings are in dollars, and half of dividends are paid to you in dollars as well if you own the FTSE 100. So absolutely, the FTSE 100 has gained from that dollar exposure. But it's also, I think, gained from the buybacks. The big commodity companies in particular are buying back shares. They're reducing their share count, they're buying back shares, and they are the big buyers of the market. You're absolutely right. Foreign investors, they'd be concerned about the UK, they'd be concerned about equities generally, and they've been sellers.
Do you follow that trend then? Do you want to align with the buybacks? Do you want to be positioning within energy, within UK? Do you want to be positioning within financials within UK?
I don't mind. I think even though arguably if you have a recession with more volatility, it's not an obvious place to be in financials and to be in commodity areas. But I do think these areas are much better positioned than they were in previous cycles. Financials, banks have better capital levels. The commodity sector is benefiting from a lack of supply, really, which is keeping prices high. This is part of what's causing inflation, of course. So yes, I think there'll be more buybacks.
As we take a step back from the UK equity story and we lead into the recession, or I should say the earnings picture this week, and I said recession because I'm thinking of an earnings recession. Is that something you're starting to have to think about now? And if it doesn't happen this quarter, does it happen in the first quarter of 2023? In terms of the timeline around the squeeze on earnings, is that something you have to factor in?
Yeah, it's tricky. For Europe, there are headwinds and tailwinds at the moment. So we're pretty aware of all the headwinds to earnings right now. There's the inflation problem, there's the higher cost, there's slowing economic growth, etc. PMI surveys have all come down, consumer sentiment's very low. But there are some factors pushing earnings up for Europe. The fact that European currencies have been so weak, which means that any company that earns outside of Europe, and a lot of European companies do, when they translate that back into euros or sterling, they're seeing the benefit. So I think the Q3 results for Europe will be okay. There'll be a few worries. There'll be a few signs, I feel, that you're getting the domestic slowdown. But I think the Q3 will be okay. Also, the summer months in Europe benefited from still a reopening effect. Still that coming through. People using some of the savings they built up over the pandemic. But again, I feel those savings, they've drawn down a lot on those. The winter, we're going to see higher inflation, higher energy costs for households. And I think there'll be less of a reopening effect. All of those things will bite, I think, in the fourth quarter and first quarter.
Okay, so it's the fourth and first quarter that really you start to see more of that pain. And you talked about the FX effects, and that's fascinating, just given what is happening with the US dollar. There's a column in the FT today saying that it's time for the US, for the Biden administration to step in to address the wrecking ball of the US dollar. So which parts of the European equity space then are benefiting from weaker euro, stronger dollar? You talked about the exporters. Are we looking at the automakers? Are we looking at luxury goods? What falls into that category?
I think definitely luxury goods falls into that category. Although a lot of luxury goods are sold in Europe, they're bought by overseas travellers coming into Europe. So we had a whole wave of American travellers coming to Europe over the third quarter, for example, a lot of them buying luxury goods, and obviously their dollars went a long way, given the strength of the dollar. So luxury goods is definitely benefiting. Autos maybe less so. It's a case for autos, they're still a little bit restricted in how much they can produce, given problems in bringing supply in. But I think the other sectors that are benefiting, things like healthcare, huge dollar earner in Europe. In fact, it probably earns more dollars than euros or sterling. So there's a lot of sectors. The mining companies, for example, dollar earners as well. They're also exposed to China, which is a bit more tricky, but I think there are around about half of all sales by European companies are outside of Europe. So I think it benefits across a lot of sectors.
Equities, I know, is your ballpark within the European space, but I just wonder about the credit and the corporate credit overlap onto that, around concerns. Yes, we've seen pretty robust balance sheets, but as rates continue to increase, the squeeze on margins, what that means for higher yields. How are you thinking about the corporate balance sheet vulnerability when it comes to the fixed income market?
Yeah, and look, I have mixed views about this. I think the large cap companies, perhaps they learned from the last cycle, really, they didn't build up sort of worrisome balance sheets through the period pre the pandemic and the pandemic. In fact, they've kept quite conservative balance sheets in many ways. They didn't up their payout ratios too much. Their dividend policy was quite conservative, and they didn't take on generally too much debt. So leverage ratios aren't particularly stretched. But the mid caps, the smaller cap companies, the unlisted sector, that has more debt. And of course, interest rates were very low, so taking on a little bit more debt maybe made sense. But that means that as interest rates rise, they're the ones that are going to be hit. And of course, that hits everybody. Smaller businesses, mid-cap businesses suffer when you get higher interest rates.
Okay, so mid-cap, smaller businesses may be something to watch in terms of the vulnerability. I guess it's going to depend on the duration of the debt that they took on, of course, at times of lower rates. Sharon Bell, thank you very much indeed for coming into the studio. Fantastic to have you in the studio to kick off the week this Monday morning. Sharon Bell, of course, Goldman Sachs' co-head of EMEA Investment Research. Maybe the full pain in terms of these equity markets within Europe, at least, towards the end of the fourth quarter and the first quarter as well. The resilience around sectors like luxury and, of course, what is happening in terms of that FX read across. And maybe the UK being supported to some extent, at least the big caps, around these buybacks that we're seeing, particularly in the energy space. Okay, coming up, how is the Eurozone going to fund its response to the energy crisis? Our exclusive interview with the EU Budget Commissioner. That is next. Of course, important details that we hope to get from Johannes Hahn. Of course, Anne-Maria Tadeo. That is up in the next few minutes. Stay with us. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Welcome back to the Open. We are 14 minutes into the European trading day. You're seeing losses of 0.3% across the benchmark European Stock 600. Futures in the US down around 0.3%. So building on the losses, the very extreme losses we saw on Friday. Again, on the back of that, a very strong labour market report with the jobless rate at a record, back to a record 3.5%. Baking in then for many, 75 basis points from the Fed, another jumbo hike in November. Let's get back to what's happening across the energy crisis and how Europe is adjusting, of course, to the constraints. The proposals now for a price cap on gas, ramping up the pressure on the EU's fiscal response. And there is a fierce debate raging over how to finance any joint measures, with Commissioners Breton and Gentiloni suggesting in an op-ed last week that there should be joint borrowing. Bloomberg's Maria Tadeo is in Brussels with an exclusive interview. Maria.
Well, Tom, good morning. And now we're going to talk with the Budget Commissioner, Mr. Hahn. And by the way, today is your annual budget conference, which, of course, for you is a very important day. But before we get into the details, though, we were talking off camera about the pictures, really horrific today coming out of Ukraine. When you see that, especially the capital of Ukraine in flames on a Monday morning, what does that make you, well, feel? But also, in your view, does it validate, perhaps, the fact that the EU has to stand with this country?
Absolutely. First, it's a very sad moment. I know this country. I know all these places, or many of these places. To see how the destruction, it's a nightmare. But it's another, so to say, example. And I would really like to use this opportunity to reassure Ukrainian people that we stand on their side and we will do everything to support them. And I'm working hard to, so to say, guarantee the financial support for Ukraine, at least for the next year, in order to finance their running costs during the war, helping them whatever is needed, really not only to survive, but finally to win the war.
To win the war. And of course, you mentioned something very important. The cost of this, it's a running cost. It's not just a one-off. How does your budget feed into this then?
Well, this is not something we can finance out of the ordinary budget. It has to be financed externally. That's why I'm in an exchange with our member states. I'm confident there is a great understanding amongst the leaders. We have to do it. We have to do it in a structured, predictable, automatic way. And I'm confident that we can get it very soon, at least to reassure the Ukrainians on this side that support is there.
And Commissioner Hahn, it's clear that Russia is the aggressor, Ukraine is a country being aggressed, but some of the ramifications of the sanctions, which of course you say you support, are felt by Europeans. You see it on the energy bills, you see it on the cost of living pretty much on a weekly basis. There's a lot of debate in Brussels in terms of how to attend to this energy crisis and potentially this economic crisis. In your view, what is the response? What does a solidarity joint response to it look like?
Well, first, nobody denies that this is a war and aggression of Russia. They have caused all the problems. It's about territorial sovereignty. They are defending also our values. So helping them means also defending us. And therefore, of course, we are affected, we are hit by this. Look at the energy prices, inflation, everything. But at the end of the day, it will help Europe to, so say, return stronger than before, because now we have to invest in something we considered already important before the war, meaning green transition, strategic autonomy in terms of our economy, etc. So it's unfortunately a kind of boost, and we will stand it. And of course, it's not easy currently, but at the end of the day, I'm very confident that, again, we return stronger than before, and we will give an example to the entire world.
And your colleagues, Paolo Gentiloni and, of course, Thierry Breton came out with this op-ed last week that made a lot of noise in Brussels, where they said a joint response means joint instruments. From your budget perspective, from your department, when you look at the idea of joint response, joint debt potentially, joint borrowing, what's your take on this?
Well, we have to understand that, of course, the leaders in the member states are very much under pressure because their people feel, so to say, the stress, if you like, the temperature in the way that people are looking on the energy bills. It's ahead of the winter. The inflation is there. Prices are skyrocketing. So we have to do something. But now it's extremely important to keep solidarity, unity amongst member states.
You think that's going to hold? That's a big question. Come the winter, will the solidarity hold? There was a lot of pushback to Germany last week because of that big package. Are you sure the solidarity can hold?
Well, this is a daily challenge, and I think everybody has to play its role, his or her role, to show this unity, because during COVID, we have demonstrated that we are able to act in a very solitary, to act together, and in order to preserve the European single market. And now it's about the same. And I think at the end of the day, everybody understands it. And the good thing is, so far, we have made significant progress in the way our energy supply is meanwhile organized, is diversified. This is one of the repower, so to say, pillars. And if you look nowadays, the share of Russian gas import to Europe is only 7.5% across Europe. And this was before 40%.
So that's a big decline. And I wonder, now that you've laid this to me, we have very short time left, but it leads me perfectly to the final question. In 2 weeks' time, about 2 weeks' time, there will be a European Council. The market is paying close attention to the 20th and the 21st, hoping perhaps there is a joint energy package by then. There has been a lot of debate in terms of what that may look like, but the European leaders said we need to get it done in 2 weeks. There needs to be something to bring down gas prices. Are you confident in your experience that in 2 weeks you can get to a deal? Because to me it seems very fast.
Well, I know that our people, our experts are working hard, not only since a couple of days, but since months. It's not easy to change the market structure, but I think there is a clear understanding we have to introduce something in order.
And prices will come down. You're confident they will?
At the end of the day, they will.
And gas prices, too. That's the key.
Of course, talking primarily of gas price, and this will have then an impact on the electricity price.
Well, Commissioner Hahn, thank you so much, and we'll see you later, by the way, because we're on a panel together at this budget conference, so we'll see you later on the day. Well, thanks so much for your time. Good to see you in Bloomberg. Tom?
Maria, great stuff. Thank you very much indeed. Bloomberg's Maria Tadeo, of course, in Brussels on the ground for us, speaking there to an official involved in those energy conversations, the importance of solidarity. Later this morning, Maria will have another exclusive interview with the Dutch Finance Minister, Sigrid Kaag, so don't miss that as well. Coming up, President Putin blames Ukraine for the attack on a key bridge linking Russia with Crimea. We have more in a moment. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Welcome back to the Open. We are 25 minutes into the European trading day. Losses of 0.3% across the benchmark. Let's get the Bloomberg Business Flash now with Alice Atkins. Alice.
Hi, Tom. Chinese chip stocks have slumped after fresh US restrictions on access to technology added to a disappointing start to the earnings season. A Chinese Foreign Ministry spokesperson criticized the curbs as unfair and said they will also hurt the interests of US companies. Recent American measures seek to stop China's drive to develop its own chip industry and advance military capabilities. Renault is said to be open to cutting its stake in Nissan. Sources say the two companies are ramping up talks over the French car maker's plans to split its electric car and combustion engine assets, due in early November. We're told Nissan is pressing Renault to reduce its stake from over 40% to 15%, which would bring it level with its own holding. That's your Bloomberg Business Flash. Tom?
Alice, here in London, thank you very much indeed. Coming up, several blasts hit the centre of Kyiv just days after an attack on a key bridge linking Russia with Crimea. And of course, after Vladimir Putin described that attack as the attack of terrorists. We're going to get more in a moment on that evolving story. So do stay with us. The market's currently across the European benchmark down 0.4%. Futures pairing some of the heavier losses, though, in the US. S&P E-minis now down 0.2%. This is Bloomberg.
is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40-year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg, the lineup.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Broad-based bearishness. European stocks follow Asia into the red after strong US jobs data solidified bets on jumbo rate hikes from the Fed. Golden Week tarnished. Chinese markets reopen in the red, weighed down by concerns over global interest rates, COVID, and fresh US curbs on tech. Plus, explosions hit cities across Ukraine after Vladimir Putin accuses Kyiv of carrying out Saturday's attack on a key bridge link to Crimea. So the geopolitics again at the forefront as we assess then that response from Moscow and from Putin to the explosion on that key bridge. We're looking now at markets that are currently across the benchmark down 0.5%, pairing some of the heavier losses, and you're seeing that reflected in US futures as well. The DAX currently down 20 points, the FTSE 100 lower by 0.6%. The Bank of England coming out just in the last hour or so, trying to reassure on liquidity, saying they will be there to provide that liquidity into the gilt markets as they look to wrap up, of course, that intervention on October the 14th. Let's switch it over, see how things are playing out across the sectors. A couple of interesting corporate stories, including around Renault and Nissan, playing into the auto space. Reports that Renault is potentially looking at reducing its stake in Nissan. Bottom of the list currently is consumer, utilities, travel and leisure, and technology. A bit of green, though, in retail, autos as well, up 0.2%. The key data point after the tightness in that labour market came through with the non-farm payrolls and unemployment at a record low of 3.5%. The key data point now, of course, when it comes to the Federal Reserve, is going to be Thursday and the inflation data out of the US. So mark that one in your diaries if you haven't already done so. Let's get back to the geopolitics then. Central Kyiv has been hit, as we said, by explosions 2 days after that attack on a key bridge link to Crimea that Russian President Vladimir Putin blamed on Ukraine. Kyiv's mayor says several blasts were reported in the city's central district. This as air raid alerts were activated across Ukraine early this morning. For more, let's bring in Bloomberg's senior reporter for international affairs, Mark Champion. Mark, what can we expect then today from the meeting that Vladimir Putin has called with the Security Council at a time when we're starting to see what looks like retaliatory attacks from Putin?
Yes, I mean, we know now already what the shape of the retaliation will be. All across Ukraine, there have been long-range missile strikes on major cities, on the civilian targets in the center of the cities. This is something that Russia's hit civilian targets many times before, but this is systematic. Oftentimes there were possible explanations in terms of what military targets were nearby when apartment buildings were hit and so on, so that the missiles may have gone astray. But in this case, we're talking about direct attacks on a central park, kind of the equivalent of Hyde Park in London, an attack on a pedestrian bridge in the middle of Kiev. And other targets that have no other possible explanation, also on civilian infrastructure, power infrastructure. So we're really seeing a broad response to what I think was probably seen in Moscow as a personal attack on Putin when the bridge that he built between Crimea and the Russian mainland was hit on Saturday.
So the targeting, it sounds like, again, of that civilian infrastructure, as you say. What do we expect then? Do we expect any further details? Are we expecting a speech, any comments from the Russian president after he meets with his national security advisors later today? And is this a pattern that we expect to accelerate in terms of the targeting of some key Ukrainian cities? And folding into that, an additional question: what is the ability for Ukraine to defend itself against these attacks?
Right. So on the Security Council meeting, it's got to be concerning. There's no routine that Putin comes out of these and automatically makes a statement. However, he could, and it is concerning that he's called this meeting, as they've already launched what is clearly a series of retaliatory attacks. He is under pressure from the ultranationalist right to escalate massively, including nuclear. So it is a worrying moment. And then, to the second, which is how does Ukraine protect itself? It needs, and President Zelensky has asked for a lot of air defense. But these are, expensive pieces of kit, and it's a large country. We're talking about a country, bigger than France. And to protect everything, to protect every city, would be an incredible enterprise.
And Mark, are the Ukrainians still making headway in their offensives in the Donbass region?
They are, and this is one of the reasons why Putin is responding in this way, because he basically has run out of conventional military response on the battlefield. He's mobilized, he's ordered a mobilization, and there will be more troops coming into the battlefield over the months to come. But at the moment, they're completely untrained, not very useful if they are thrown into the front. And the Ukrainians are continuing to make headway. The Russians really haven't had a response on the battlefield for a while now. So this largely explains why Putin is responding in the way that he is on largely civilian targets, hoping one has to imagine that this will break the popular support for the war in Ukraine, but that seems highly unlikely to happen.
Okay, thank you. Bloomberg senior reporter for international affairs, Mark Chamberlain, who has, of course, spent a lot of time on the ground in both of these countries and follows this story in minute detail. Now, US employers continue to hire at a solid pace, with the jobless rate unexpectedly returning to an historic low in September. In an interview with Bloomberg TV, Labour Secretary Marty Walsh flagged risks to the labour market from rising prices.
We need to continue to bring down the inflationary pressures that people have. Certainly, what OPEC made a decision on this week to do was not helpful to us. The president was disappointed. We're disappointed as administration, but we need to continue to bring down those pressures. I mean, I think that, I had a long conversation in my office today. I certainly don't want to see the unemployment number go up. I like to see people working.
That's what the Fed is forecasting. Some people say that's the objective. How are you preparing for the pain that they're forecasting? And what can we do on the supply side when it comes to things like immigration?
Well, on the unemployment, we were talking for the last 3 months about seeing those numbers go down. And in the year 2022, we've had about 440,000 jobs per month. We're still seeing 263,000 people going to work today. This month, I should say, last month, we're still seeing those numbers going on. So I think that that's something that is important, that we continue to put those gains. We still have job openings. People are still looking for work. Obviously, we'd like to see the participation rate a little higher. I mean, that number went down a little bit this month, I think 0.1%. So we have to see what's happening there.
Clearly, the employee over the last couple of years is getting some leverage it hasn't had for a few years, a number of years, maybe even decades over their employers. You brokered a deal with unions in the last few months with freight rail companies, the 12 unions. I understand 4 of them have ratified the deal, Marty. Secretary Walsh, are you worried about the other 8?
No, I'm not. I mean, they're out there explaining, when I say they, the union leadership now and the bargaining committees are out there explaining to the members what's in those contracts. It was a very painful negotiation, not what I had, but leading up to me. 2 years of negotiation with really no movement. And I think that there's explaining to do in these contracts. And I look at these contracts, they're good. They're a good contract. I mean, it's 24% over 5 years, healthcare freeze cap, work rules change. It was a good contract for the employer and employee as well. So hopefully we can get the rest of these ratified in the next 6 weeks.
In the Rose Garden, the president said this: because of this labor agreement, those rail workers will get better pay, a 24% wage increase over the next 5 years, improved working conditions, peace of mind around their healthcare by capping the cost that workers will have to pay. Have the port workers on the West Coast, Secretary Walsh, asked for the same conditions?
No, I mean, I don't know. I don't know what they're asking for wages and benefits, but certainly those are all the conversations that are generally on the table. A little different negotiation. The West Coast port negotiation is a very fluid conversation. That both sides are at the table. They're both having conversations. It's a longer process than I anticipated, but that's just historically the way they've operated. They kind of take one segment at a time. I stay in close contact with both the employer side in the unions on the West Coast port, and both sides have expressed to me that they're still moving forward. There'll obviously be sticky issues that'll pop up every now and then, but nothing that's making me be concerned that I have to have a 20-hour meeting in my office about.
Okay, Labour Secretary Marty Walsh speaking with Bloomberg's Jonathan Ferro. Coming up, Credit Suisse's securitized products unit draws the interest of 2 big names. We're going to get the details. That is next. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
But look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
To be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points, and so that's what we're doing.
Welcome back to the Open. Happy Monday. This is how the Europe market is trading right now. The benchmark is down 0.3%. repairing, it has to be said, some of the heavier losses at the start of the session. Futures in the US pointing lower by 0.2% on the S&P E-minis. Quickly checking in on your currencies. Euro dollar getting you 97 US cents for the euro. The pound is at 110 flat. The BOE reiterating its determination to step in with liquidity if and when needed as it looks to wrap up that special operation within the gilt markets by the end of this week. Let's get to what's happening on the corporate banking front. A couple of pretty fascinating stories evolving. Of course, we cannot spend too long away from the Credit Suisse story, and that bank has drawn the interest from the likes of PIMCO and Centerbridge Partners for its securitized products unit. A deal for this part of the business is a key pillar of the Swiss lender's plan to downsize its investment bank and would help pay for that restructuring. Joining us for the details is Bloomberg's Charlie Wells. Charlie, what is the appeal of this part of the business? Are they likely to get a good value for it?
Yeah, so Tom, this is a striking part of Credit Suisse's business. You know, they sell securities that are backed by, you know, pools of assets like mortgages, famously, but also credit card debt, car loans. And historically, this has been a profitable unit. By some measures, it has $75 billion in assets. You know, the risk here is that this sort of business involves a lot of capital, but it could potentially give some of these investors who are expressing interest in it access to some of those credit products. So good price, I couldn't say, but, you know, there are multiple people who are interested in this, so that's a good sign.
Yeah, so it's an attractive unit for Credit Suisse, or at least the potential buyers, and as it looks to this major restructuring. Of course, we expect that announcement. Investors looking very closely at this kind of beaten down stock and company amid all the challenges. When it comes to Goldman Sachs, very, very different story, but they face some challenges, not nearly on the same scale as Credit Suisse. But when it comes to the consumer part of the business, we all remember Marcus, particularly entering here in the UK market, but now they're starting to walk that back. How big a shift is this, and why are they doing it?
Yeah, so this is a really great story on the terminal, Bloomberg's Big Take, and it's actually talking about how, yes, Goldman, you know, had dreams of really becoming kind of a centerpiece on Main Street in terms of retail banking. An executive at the bank at one point said he wanted Americans to think of Marcus, that retail product, as a, quote, lovable teddy bear, kind of having, you know, more positive associations with Goldman. But what we are seeing is some backtracking. So there was effectively a funnel that the bank was trying to create to kind of bring in kind of the everyday consumer. These are things like checking accounts. These are things like robo-advising. Those are now being dialed back and offered to a more limited set of wealth management consumers who tend to be wealthier. So this is a significant change from plans that Goldman has had for a really long time.
How much of this is down to the regulatory concerns? They faced a little bit of pushback, some concern amongst regulators.
Yeah, so they were they were moving very quickly. You know, I believe that it was the consumer CFPB. I believe that it was the Fed as well asking questions. And I think anytime you see a bank trying to move into the retail space, things like fees will draw the interest of regulators. But it's just such a difficult space for Goldman, right? It's expensive to get in here. And I think that could have drawn some concerns as well. The technology is really difficult to pull off. And it's an incredibly competitive landscape, right? You've got the kind of legacy banks operating in this space, the JP Morgans, the Banks of America, but you also have challenger banks, right? Chime, SoFi, that really have laser focused on user experience, and that's just so hard to match.
I love this story because it's fascinating. Goldman Sachs, with all the financial clout that they have and all that brand prestige, and yet, as you say, because of all those challenges, having to walk back their push into consumer and the retailer there. Thank you very much indeed, Charlie, as ever. Fascinating and fantastic on the story. Credit Suisse as well, potentially looking to spin off one of its units. We'll continue to watch both of those stories. Let's get the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. UK Prime Minister Liz Truss is planning to speak directly to MPs in her Conservative Party this week as she seeks to rescue her premiership. The Bank of England, meanwhile, has this morning announced additional measures to support market functioning. The bank will increase the size of its buying operations for the next 5 days to a maximum of £10 billion, double its previous level. China is stepping up efforts to contain COVID outbreaks ahead of the Party Congress. Nearly 1,900 cases were reported yesterday, the highest level in almost 2 months, fueling concerns about widening lockdowns rippling across the financial hub of Shanghai. Meanwhile, PMI data showed China services activity contracted in September for the first time in 4 months as lockdowns dampened consumer spending. French President Emmanuel Macron has urged citizens not to panic and to act responsibly after a refinery strike left petrol stations with no fuel in some regions. The Transport Minister says the government may release additional strategic fuel stocks in a bid to alleviate the tight market. A labour strike has hit the country's two biggest refineries, affecting almost 2/3 of the nation's capacity. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom?
Alice Atkins, thank you. Coming up, is the Fed preparing another aggressive hike after those strong job numbers? That is the expectation. We're going to get the market reaction next. This is Bloomberg.
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go. Instant reaction on Bloomberg Surveillance.
Inflation is still sticky. The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blame.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in Focus, Thursday on Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Earnings expectations have fallen sharply for the third quarter. We believe that they're going to be better than expected. The official rate now for the third quarter from FactSet is a 2% gain, with several sectors in the negative territory. We think that 2% is too low.
As much as I hear people tell me the consumer's in good shape, they're not. In the U.S., the savings rate's decade low, credit card usage is decade highs, and it's definitely a deceleration.
In the U.S. is nothing that any of us like to write home about, so to speak. Nevertheless, the economy is on a more solid footing than most places, and earnings still look attractive.
The next move lower will be a more realistic assessment of earnings by analysts.
Going into the third quarter earnings season, if we have some positive surprises, the market's looking for good news, I think it'll react.
Some of our guests there answering the MLive Pulse question of the week. Will earnings bring a rally or a fresh low? Welcome back to the Open. We are 52 minutes into the European trading day. You're seeing losses of 0.4% across the benchmark. The DAX just managed to squeeze out some green. Now it's range bound. Losses here in the UK of around 0.6%. The FTSE 100 down by 42 points. And the futures in the US pointing lower by between 0.3% and 0.4%. Joining us for the details on this market action is Bloomberg's Jan Patrick Barnett. Jan, let's start with the question of the Fed, those incredible job numbers, that record low in terms of the unemployment rate, 3.5%, continuing to weigh on these markets then?
Yeah, definitely. The market was looking for a much lower number. Some of the whispers that were going around were like below 100,000, so we didn't get that, and the market reaction was crystal clear on that. So that's super disappointment. We saw this continuing in the early future trading today. The market is now pairing those losses a little bit, but the next step will be certainly Wednesday and Thursday. Thursday is probably the big one with the CPI and PPI numbers. Again, the market is looking here for a relief number. So the consensus is for 1.8 after 8.3 in the last month. But what I'm hearing is that people would actually love to see a number with a 7 in front of it. So we will see if we get that.
Okay, indeed. And one of the corporate stories, and this is one of the stocks that is actually in the green this morning, is Credit Suisse, on the story that it may be looking, or at least there's some buyers eyeing up its securitized products business. The importance then, Jan Patrick, for Credit Suisse of this development and the broader banking space?
Joe, I would say it's very important for Credit Suisse. Everybody was saying like they want to see a decisive, they want to see a strong recreation of the bank. That's probably just like one tiny step on the journey there, but you can clearly see from the market direction that everybody who is like still wants to believe in Credit Suisse with all the troubles they have, they want to see that the lender is refocusing on its core business, on wealth management, and that also means like that they have to sell some of the business, even if it's profitable.
And Jan Patrick, we came into this segment with some sound on the question of earnings. There's a lot of debate still as to how much of a drawdown we expect to see, how much of a re-rating around the earnings picture as we look, of course, at some of the big names stateside reporting later this week. How are investors kind of squaring up to this question?
Well, we have still this like big discrepancy between what analysts are expecting, what the market is actually pricing. So analysts are still like for a let's say a rather positive earnings season, while the market has already priced in something between 10 and minus 15% in earnings. So the question is like when we are getting something like we have seen in the second quarter, that we get an earnings season that is not as worse as feared, that could actually spark quite the market rally there.
Okay, so we'll look ahead, of course, the importance of those earnings amid continued focus on the central banking action as well, Jan Patrick. Just one last one, very finally, very quickly. 75 basis points in November. Does it change the pricing at all?
Well, I think it's still on the table, and the market is still like expecting that. I mean, everything less than the 75 basis points would probably be positive. I'm not sure they go. Sometimes the people were touting like 100 basis point move. That we probably would only get like if inflation is a massive surprise to the upside, which it doesn't look like right now. 75 basis points, I think the market can live with it. But if we get like a lower inflation number on Thursday, then I'm pretty sure the rates market will reprice that.
Okay, the inflation number out on Thursday, as you say. Laser focused on that later this week. Thank you, as ever, Bloomberg's Jan Patrick Barnett, breaking down brilliantly what is happening across these markets and some of the key catalysts and drivers. Your benchmark European stock 600 is currently turning lower now by 0.5%. S&P E-minis off by 0.4%. And the Nasdaq is in the red as well by close to 0.5% after the beating that stocks got on Friday. Again, that inflation data out of the US will be central. We continue to watch the geopolitics as well as Russia takes out retaliation on Ukraine. Stay with us. That's it for the European Market Open. Surveillance Early Edition is up next. This is Bloomberg.
There's an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together. Now I would have a much more experience about for those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Not only does it have to overcome inflation, but it has to restore its credibility. So yes, I fear that we risk a very high probability of a damaging recession that was totally avoidable.
I think we are headed for a collision of some kind or other, and I think the sooner we start managing for some slowdown, the better we're going to do. I think Chairman Powell was way late to come to that recognition, but he now has that recognition, and he should be supported in that.
The pace of job growth is cooling while still powering our recovery forward. Wage growth for workers remains solid, down from historic high pace months ago, but still growing for workers who deserve a raise. And this is the progress we need to see.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Broad-based bearishness. European stocks follow Asia into the red after strong U.S. jobs data solidified bets on a jumbo rate hike from the Fed. Golden Week tarnished. Chinese markets reopened in the red, weighed down by concerns over global interest rates, COVID, and fresh U.S. curbs on tech. Plus, explosions hit cities across Ukraine after Vladimir Putin accuses Kyiv of carrying out Saturday's attack on a key bridge link to Crimea. Well, it's a market just so far away from that pivot narrative. It is now far in the distance, and it is a market that continues to sink after the losses on Friday, with unemployment staying at the lowest in quite a few decades. You're looking at S&P 500 futures, which continue to fall down 4%. This as we see the world's global financial chiefs gather in Washington for the IMF meeting. Will there be even more pressure to the Fed to reverse course, considering the reverberations we've seen it had across the world with a strong dollar and a bond market in pain? Now, speaking of which, of a bond market in pain, we're going to get more into depth about this, but just want to point out the Bank of England announcing this morning that they're doing more to backstop this market, be it a repo facility that they're extending out beyond the Friday deadline and having larger auctions. It's a calm market so far. We did have gains in sterling this morning, flipped to losses, but not too severely, and a steady bond market as well. We're actually looking at yields higher by about 3 basis points. Also, just quickly want to point out Hong Kong tech. Chip makers getting decimated, whether it was in the U.S. session last week because of higher rates. Today, it's about the U.S. putting fresh curbs on China chip, on U.S. chip technology being shipped over to China. The concern there is that could have profitability credibility for the Chinese chip sector, according to Bloomberg Intelligence. So that's the view across the globe. Let's zero in on Europe because it does look to be, again, a day of red. Now, it varies depending on the region. For example, some of the utility makers in here, those are under pain. There was an FT report that the UK may be looking at capping profit of renewable energy sources. So utilities, one of the worst performing. The FTSE MIB, that's down about 0.5%. DAX not doing as poorly, down 0.25%. And the FTSE 100 down about 0.7%, despite the fact Goldman Sachs pointing out that corporate Britain has been on a buying spree, the biggest bout of buybacks this year on record. Well, let's stick with that UK story. I mentioned it, the Bank of England stepping up its pressure to support market functioning as its emergency gilt buying measures enter their final week. Now, the UK central bank said it will increase the size of its buying operations for the next 5 days to a maximum of £10 billion. That's up from $5 billion previously. Let's dig into it. We're joined now by Altaf Kazam, head of EMEA Investment Strategy and Research at State Street Global Advisors, and our markets editor, Christine Aquino. Altaf, Christine, thank you both so much for joining. Christine, I want to kick it off with you. Can you just explain what the BOE has done here?
Well, in essence, Danny, this is a way for the BOE to support the bond market in a more targeted way, particularly after we saw really the pension market really getting hit by the losses in bond markets over the last couple of weeks. Now, initially, the response of the BOE to that was to just step in with emergency bond purchases, but we know that that puts the BOE in a very awkward position because they really want to be getting away from those bond purchases, right? This is the whole process of the policy normalization that they've been embarking on. They're doing rate hikes, they want to tighten policy, and so the last thing that they want to be doing is stepping back into the bond market and buying them. And so now what we got from the BOE this morning is essentially a way for them to provide targeted support, particularly for the pension funds that do liability-driven investments without kind of just outright buying bonds. So in a way, it's kind of getting them away from that awkward position and helping them kind of continue their policy tightening process.
Is it enough, Altaf? Is this enough to calm the market?
I think it is. I mean, I think, like Christine said, what the Bank of England needs to do is kind of draw a line under things, make the market feel confident that they've got the back of the pension funds, but not make it seem like it's an open-ended promise to keep buying gilts. So I think they've done enough. Time will tell if there's more instability in the pension funds, but I think for now this will work.
It works just on a practical level, but what about when it comes to credibility of the Bank of England? Do they face a crisis of credibility?
I don't think the Bank of England itself faces a crisis of credibility. I think the market viewed what they did as pretty credible. I think the government, on the other hand, is facing something like that, and that will have to be addressed in the next few weeks.
It is interesting because this is coming as the IMF is meeting, right? All the chiefs gathering in D.C. And Christine, it does feel like this theme of, monetary policy and fiscal policy being at loggerheads. To what degree is this a UK problem versus a wider global economic problem?
Well, to some extent, it is something that a lot of governments and central banks are facing at the moment. This kind of, how do we really align fiscal and monetary policy at a time like this when inflation is out of control, but then you also have a lot of consumers very, very worried about a recession. But in the UK, I think it's particularly interesting because what we saw from the government in terms of the mini budget really put fiscal policy at a much bigger loggerhead, as you mentioned, against monetary policy than perhaps other G7 nations. And that is precisely what markets reacted really so negatively to. The fact that monetary policy on the one hand is hoping to rein in inflation, but then you have fiscal measures that kind of seemingly go against that goal. And so it's going to be interesting to see what sort of reception Kwasi Kwarteng is going to have at the IMF meetings this week at the backdrop of, given that this is the backdrop of the UK.
Yeah, to be a fly on the wall. Not just for that, but I would love to know what the calls between Kwasi Kwarteng and Andrew Bailey are like every day. I'm sure there might be a little bit of tension in there. But to that point, I mean, can the BOE really start QT on October 31st, given everything that's happened over the past few weeks?
I think it's really unlikely. I think with the way that the pound has fallen, that gilt yields have gone up, the prospects of it getting into kind of full-fledged QT, getting rid of bonds from its balance sheet when it's just spent a couple of weeks buying them to calm the market down, I think that's really unlikely, and I think we'll see an announcement of a delay of that program.
What do you think? A delay? Is that possible?
Yeah, I mean, we are starting to see kind of the narrative and uncertainty around this QT process. And I think, what the BOE has done, they have maintained the flexibility over what they're going to be doing, right? They never actually have definitively said, we're definitely going to start it at the end of this month. And so I think that kind of buys them some room to kind of say, you know what, given the market conditions, perhaps this is something that we can table for a little bit later. But at the same time, I think markets will look for the BOE to eventually signal when they're going to start that process. And so I guess it would be quite interesting to see what markets are prioritizing at this point, kind of seeing the BOE carry on with that QT policy normalization process as they've carved it out initially, or would they prefer the BOE to kind of have more firepower to respond short term to some of the acute stresses in the market at the moment?
How do you see that division between this ability to jump in, make short-term decisions to help alleviate the stress versus, I mean, dealing with inflation, hiking interest rates?
Yeah. I mean, the UK is in a very tight spot. It's got the tightest labour market in the developed world because of Brexit-induced labour supply shortages. It's got a currency that's weakening even as bond yields are going up. So the Bank of England is in a very tight spot. Like I said, it did the right thing, we think, by protecting the pension funds at very short notice. But it's going to have to walk that tightrope eventually, and eventually it's going to have to stop buying those bonds and start going for QT.
And who's going to buy those bonds when they're gone?
I mean, there's still a bit of demand, I think, from overseas investors. I think a lot of investors are starting to nibble at sterling assets with the currency being so cheap. That applies across the board, fixed income, property, even equities, I think, are starting to see a bid now. So there is value in the UK market. It's just a question if that value will be destroyed by political risk.
Yeah, and Christine, I want to get one final one in from you before you leave us. I mean, stepping in, I don't know, Christine, but anyway, stepping into the bond market, looking for higher yields, finally buying. I want to expand this beyond just the UK, but yields in general finally look attractive. Is Tina dead? Is it now Tia? There is an alternative?
Well, I mean, the bond bulls would like to have you believe that that is the case at the moment. I mean, we have seen over the weekend, Bill Gross aligning with his former PIMCO colleagues and saying that bond yields are attractive now. It's time to step in. I just wonder whether that is something that would make sense 6 months down the line, because right now we're still kind of hearing from the Fed essentially doubling down on their message that no, tightening is going to continue. This pivot narrative doesn't make sense at all at this point in time. But I'd say 6 months from now, because that would be right around the time when markets at least are pricing for the peak of the Fed funds rate to be hit. And so it would make more sense to be a bond bull at that time versus now. But certainly, this is what markets do, right? They front run a lot of these themes way ahead of when it actually comes to fruition. And so I think, this idea of higher yields finally reaching a point where it's become attractive to investors does carry a lot of water as an idea. It just depends on the timing, as always.
Altaf, I know you have thoughts on this. You stay there. We're going to go to break, but we got to talk Fed pivot next. I'm sure we will get very thoroughly into it. Altaf Kassam, head of EMEA strategy and research at State Street Global Advisors, is going to stick with us. And thanks, as always, to our very own Christina Aquino. Now, coming up, the latest jobs data out of the U.S. reaffirmed traders' bets on another big rate hike next month. Now the focus turns to inflation data due this week. It's CPI week, folks. That U.S. outlook is up next. This is Bloomberg.
More activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
We are headed for a collision of some kind or other, and we've just got to manage that collision carefully. And I think the sooner we start managing for some slowdown, the better we're going to do. I think Chairman Powell was way late to come to that recognition, but he now has that recognition, and he should be supported in that.
Former U.S. Treasury Secretary Larry Summers there on that outlook for the U.S. economy. Still with us to discuss that outlook, Altaf Kassam, head of EMEA Investment Strategy and Research at State Street Global Advisors. Now, Altaf, we just finished before the commercial break talking about UK yields, that it looks like some people are starting to jump back in. Valuations are cheap enough. Can the same be said with U.S. Treasuries?
I mean, I think U.S. Treasuries right now, given the yield, look very attractive to a lot of investors, given the strength of the dollar. They've been a really great performing asset in terms of the income they're providing. But I think you're going to have to expect more capital losses as rates continue to rise. So it might not be the time, if you want to time it perfectly, to jump back into U.S. Treasuries. But I think if you're willing to wear some capital losses over the short term, it might be a good time for a patient long-term investor there.
Is there a level that they become just too attractive you can't resist? And are we close to that level if so?
Yeah, this isn't the answer you're looking for, but I think the level they become attractive is when we're sure that inflation has turned.
Okay, fair.
So then we feel much more confident on the pivot, and then it is the time to buy. Obviously, you'll only know that when you look backwards, but I think missing out on the first, say, couple of months of a bond market rally, a genuine bond market rally, is a price worth paying to not get a burnt in the short term.
Well, let me complicate that even further in the interest of not having anything clear-cut, because we live in a world of gray. Even if we start to get indication that inflation is turning, can we be sure that the Fed will turn too? In other words, does peak inflation necessarily mean peak hawkishness?
I mean, the Fed has promised to be data-driven and not use forward guidance, in other words, to scrutinize every data point, which is why we see so much volatility in the market, why everyone's focused on the next print. But at the same time, unfortunately, the effect of rate rises have a lag. So even if the Fed does reach peak hawkishness soon after inflation peaks, the effect of the rate rises they've already made will still be percolating through the economy for, say, another 6 months.
You say that, and they've said that, you know, they're data dependent, but we've still heard from many Fed officials, Williams being the latest, saying we're going to 4.5%. I mean, that sounds like a forecast to me. Yeah,
that does sound a lot like forward guidance. So maybe he's just, referring to the dot plots, the summary of economic projections, the long-term rate. Maybe he's just trying to do his own version of whatever it takes and talk the market into the Fed's point of view. But if they truly are data-driven, they will keep an eye on, I guess, the inflation numbers that are coming up on Thursday for a start.
How does this dynamic play into the credit cycle? Because at the moment, it is really just an issue of interest rate risk. At what point does that morph into credit risk?
Yeah, I mean, you've been talking about earnings, and I think that is the next thing that the market has to focus on. How much corporate earnings are being hurt by interest rate rises, and how much corporations are able to pass on the effect of higher inflation. Both of those will feed into corporate credit, and that's where we'll start to get an inkling of whether this is going to start causing distress and defaults. We haven't seen it yet, but it's something that we're keeping a very sharp eye on.
Altaf, I want to point out, I know we were talking about the UK earlier, but I just want to go back to it because I'm seeing some pretty substantial moves. 30-year yields taking the brunt of the beating right now. Yields up by 14 basis points. Front end not as bad, 8 basis points when it comes to the 2-year. But it does look like a market that's starting to test the BOE again, even though they've come out with this idea that they're backstopping the market even further. I mean, you can see it there. So 14 basis point move, even though the BOE has come out and tried to calm markets. Does this portend anything for you for what happens after this week when the training wheels are off?
No, it does worry me, and the fact that this is a huge market that appears to have a bit of dysfunction is definitely worrying. We're going to see mistakes. We're going to see things break. This might be the first example, so it really will be a test of the Bank of England for sure.
What does it mean in a world where you're looking at these assets, 30-year yields in the UK, even treasuries to some extent that have been very volatile, an asset class where portfolios revolve around the fact that they're calm, that volatility is low? What difference does it make, just the volatility aspect of this?
It makes a huge difference because, like you say, as an asset allocation kind of constructor myself, I relied for 10 years, 20 years on bonds being smoothing out equities. I can't rely on that anymore. That equity bond correlation has gone positive, and I don't think it's going to come down anytime soon. So you have to look for other sources of diversification. You have to get more defensive in your equities, and just having a 60-40 portfolio and putting it in the top drawer and locking it away, it's not going to work.
Okay, well, we'll end with that sage yet depressing wisdom there. Altaf, thank you so much for joining us this morning, playing ball with the breaking news, breaking moves in these bond markets. Altaf Kassam, head of EMEA Investment Strategy and Research at State Street Global Advisors. Coming up on the program, rockets hit the center of Kyiv for the first time in months, following an attack on a key bridge linking Russia with Crimea. More in a moment. This is Bloomberg.
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg Surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blink.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in Focus, Thursday on Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
For a young person who now looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
Be
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to the Bloomberg First Word News now, and with that is Leanne Gerrans. Good morning, Leanne.
Good morning, Danny. Missiles have struck Kyiv and other Ukrainian cities 2 days after an attack on a key bridge to Crimea that Russian President Vladimir Putin has blamed on Ukraine. Kyiv has not officially claimed responsibility for the blast, although it has celebrated the explosion with a new postage stamp. Here in the UK, the Prime Minister Liz Truss is planning to speak directly to MPs in a Conservative Party this week as she seeks to rescue her premiership. Meanwhile, the Bank of England has this morning announced additional measures to support market functioning. The bank will increase the size of its bond buying operations for the next 5 days to a maximum of £10 billion, double its previous level. Now, the French President Emmanuel Macron has urged citizens not to panic and to act responsibly after a refinery strike left petrol stations with no fuel in some regions. The Transport Minister says the government may release additional strategic fuel stocks in a bid to alleviate the tight market. A labour strike has hit the country's two biggest refineries, affecting almost 2/3 of the nation's capacity. And China stepping up its efforts to contain COVID outbreaks ahead of the party congress. Nearly 1,900 cases were reported yesterday, the highest level in almost 2 months, fueling concerns about widening lockdowns rippling across the financial hub of Shanghai. Meanwhile, PMI data showed China's services activity contracted in September for the first time in 4 months as lockdowns dampened consumer spending. Global news 24 hours a day on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. Leanne Gerrans there. Now, we continue to see pressure in this UK market. It is a bond market where the pressure is back on, with a BOE who attempted this morning to get ahead of any market pressure, considering that their bond buying program will end on Friday. So what have they done? They've doubled the amount of daily purchases they can make in the auctions, and they've also announced a temporary expanded collateral repo facility. The hope is with that they can stem some of the damage from this LDI, relieve some of the liquidity issues, but still it is a long end that is selling off. We're up about 13 basis points here, still off the high, which was over 5%, but still, it is clear that this market is willing to test the BOE. Yes, the training wheels are coming off. Yes, they're trying to do more to step in and stop some of the hurt. However, the total purchases were only £5 billion. So is the risk really washed out of this market when it comes to LDIs and UK pensions? Now, coming up, we're going to talk about Credit Suisse, their securitized products unit, drawing interest in some of the big names. We'll discuss that next. This is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
But look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We have to be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points, and so that's what we're doing.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Broad-based bearishness, European stocks follow Asia into the red after strong U.S. jobs data solidified bets on a jumbo rate hike from the Fed. Golden Week tarnished. Chinese markets reopen in the red, weighed down by concerns over global interest rates, COVID, and fresh U.S. curbs on tech. Plus, multiple fatalities are reported as rockets hit Kyiv for the first time in months. It follows Saturday's attack on a key bridge linked to Crimea, which Putin blames on Ukraine. Good morning. Happy Monday. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London. Now, Bloomberg understands that PIMCO and an investor group that includes Central-Bridge Partners are among the short list of bidders for Credit Suisse's securitized products business. A deal for this part of the business is a key pillar of the Swiss lender's plan to downsize its investment bank, and it would also help to pay for restructuring. Bloomberg's Tom Metcalf is with us to help us dig through all of it. So, Tom, another twist and turn of the Credit Suisse story. Where do we stand? What's the latest state of play?
Yeah, after last week's very much a wild week in the market with Credit Suisse, it started on sort of more positive foot with this news that, there are interested parties in this securitized products group. And as you just said, it's really a key element of their hopes to sort of stabilize the bank and move forward. And really the questions are, what happens next, both for this section, but the other options that the bank are looking at.
So what options then are we hearing from the bank to raise money? What are they dabbling with?
Yeah, so alongside the securitized products thing, the other thing would be perhaps spinning out sort of the advisory arm of the investment bank, even under the name First Boston, which it was sort of retired a few years ago. And then also, these are seen as maybe perhaps less likely, perhaps an IPO of the Swiss unit, or even more dramatically, perhaps just trying a straightforward capital raise. But the problem with that, of course, is that with the share price at these record lows, it's going to be a very, very expensive way of doing it. So both those options are sort of seen as much less favorable.
Well, they've given themselves pretty much until October 27th to announce what sort of restructuring, what shape the bank will take from here on out. Is this a market that's willing to let them go, willing to let them formulate this idea until the 27th?
Yeah, it's fascinating. Look, last week you saw the share price fall 12%, and by the end of the week it was up 15%. So it's sort of very turbulent times right now. I think, that is everything we're hearing is it's all going to build up to this sort of big event, this sort of strategy briefing to investors on the 27th. And there'll be a lot of great data coming out of that as well. You'll see sort of client inflows and outflows. So obviously Credit Suisse will be wanting to tell a particular story to its investors there, and then the question is how the market reacts.
Okay, Tom, thank you very much. Bloomberg's Tom Metcalf there. Now let's change gears a little bit and dive into the UK banking story. We're joined now by Benjamin Toms, Director of Equity Research for UK Banks at RBC Capital Markets. Ben, thanks so much for joining us. So Immediately this morning, we get the BOE trying to get ahead of any market sell-off with the sort of training wheels falling off on Friday. They're going to up the amount of bonds they're purchasing, and at the same time, they're putting in this longer facility, this longer repo facility for LDIs to help smooth out liquidity issues. Is it enough? Are there still UK banks who are potentially exposed to liquidity problems when it comes to pensions selling assets?
I think you can split the banks into two, really. There are some that are quite exposed to movements in the rate curve, but the others we think are pretty well hedged, and for the domestic UK, it shouldn't be too much of an issue.
How big is that split? In other words, should we be worried?
No, I don't. To be honest, this quarter, you're going to have some weird movements going through OCI for a bank like HSBC because of movements in the rate curve, but for the majority of the banks, I think it should be okay.
Of course, the other reaction to this, potential inflation moving on, less tax revenue, is a BOE that's had to hike rates more. Obviously, the impact there is on the mortgage market. You write, Ben, the squeeze is coming. What does that squeeze look like?
Yeah, I think it depends also what type of customer you are. So you may know that the banks in the UK issue mortgages of different kind of tenures, and 15 to 20% will roll over straight away. If you've got one of those mortgages, you'll be seeing higher rates today. Other customers, it's split between 2 and 5 year products mostly, and so you have some time there if you are one of those customers. But for anyone rolling over this year, you've got a big kind of squeeze coming, particularly when you add into the fact that food costs are going up and energy costs are going up at the same time.
Yeah, because we debate this idea on the show very frequently. Can the BOE hike as much as markets are saying because of the damage it will do to the consumer? Is there a level of rates at which you say the damage is immense, the damage is very bad?
I think when we've heard UK banks talk previously, they've talked about rates being over 4% as the real problem, and that's when they'll start seeing asset quality problems. On the other side of it, you've got unemployment, which is staying very low at the moment, and the banks would point out that whilst unemployment stays pretty low, that tends to be pretty good for cost of risk and impairment at UK banks.
I mean, it's quite the mix. Things that are clearly beneficial, things that are extremely worrying. So what is your outlook when it comes to this last quarter of the year?
Yeah, I think for the next couple of quarters, you're going to get banks produce very good results. Deposit betas, which is another way of saying the amount that rates get passed on to the consumer, seem to be staying quite low. And whilst that's the case, NII is going to be very good for the UK banks. However, once you get into next year, I think you've got two problems that are going to come through. So 50% of banks' cost bases are salaries, and you've got high inflation and wage inflation, which is going to flow through there. And then you've got a debate around impairments. The market at the moment is pricing in lower than through the cycle cost of risk for next year. We're a bit more bearish, we think, above through the cycle, mainly because of the work we've done around mortgages.
Okay, really interesting stuff to unpack there. In terms of remuneration, have banks started to slow down? Have they started to cut staff? We've certainly seen that happen in the US. Same thing happening here?
Well, firstly, in terms of pay, we saw top-ups at the half year where banks increased salary rises that didn't come through in January of last year. In terms of headcount reductions, we've seen a few bits trickle through, but I expect the deluge is probably still to come.
Okay, and the other part of that, the impairments, how much do you expect that they will need to set aside?
The banks?
Yes,
well, if you speak to the banks, they will tell you that they come into this potential recession next year with coverage levels being high. They've got COVID-19 impairments still in place. LTVs are pretty low and unemployment's pretty low, and credit card mix is also quite low. So all that adds together to say that cost of risk should be okay. But when you look at the sheer amount of pain that the consumer is going to get next year in terms of mortgage payments, it's difficult to see that cost of risks won't go at least 5 or 10 basis points above through the cycle levels.
So consumers, potentially those cracks are showing, but on the corporate banking and specifically corporate lending side, it's been really fascinating to watch a market that essentially seems frozen, that banks are just really unwilling to lend right now, unwilling to bring these packages to market because the amount of concessions they have to take are just so massively high right now. What does deal making look like in the UK for these banks? Is this still a market that is frozen considering the risks at this moment and the widening credit spreads?
Just to bring it back to mortgages for a second,
yeah,
I think banks have pulled mortgage products,
right?
And I think they probably get a hard time in the press about the size that rates are for new mortgage holders. But if you look at the spread data from last quarter, banks are making less money on mortgages than they have done for years and years and years. So it's worth remembering that their funding costs are going up at the same time. And then in terms of the kind of corporate element, I think, as you mentioned at the beginning, the Bank of England and government policy at the moment is creating an uncertain environment. And whilst that uncertainty exists, I think banks will hold back from kind of putting their balance sheet to work.
And, in terms of net interest income, because last month when we had banks reporting it, it was obviously, a better reporting season for them. Is it the pace of gains in interest rates that is the issue here? Because obviously, just in general, higher interest rates means better net interest income.
Yeah, you're right. There generally, for most banks, is a correlation between higher rates and better net interest income. I think the key determinant here is deposit betas and where that really sits. But the speed at which it happens makes a big difference for banks, how they price their mortgages. If it happens too quick, they can't get the product out quick enough, and they then start losing spread on the product they have that's out there. So there will be a period of catch-up for a couple of months to come, and that's why we see mortgage rates about 6% at the moment. They could trend higher.
Certainly no boring times for you ahead. Ben, thank you so much for joining us. Benjamin Toms there, Director of Equity Research for UK Banks at RBC Capital Markets. Now, coming up on the program, several blasts hit the center of Kyiv just days after an attack on a key bridge linking Russia with Crimea. More on that in just a moment. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betrayed you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci is really teetering on the brink at this stage.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to your Bloomberg Business Flash. With that is Leanne Gerrans. Good morning, Leanne.
Good morning, Danny. Chinese chip stocks have slumped after fresh U.S. restrictions on access to technology added to a disappointing start to the earnings season. A Chinese Foreign Ministry spokesman has criticized the curbs as unfair and said they will also hurt the interests of U.S. companies. Recent American measures seek to stop China's drive to develop its own chip industry and advance military capabilities. Renault is said to be open to cutting its stake in Nissan. Sources say the two companies are ramping up talks over the French car maker's plan to split its electric car and combustion engine assets due in early November. We are told Nissan is pressing Renault to reduce its stake from over 40% to 15%, which would bring it level with its own holding. And Chinese food delivery giant Meituan is said to be considering expanding into international markets as domestic growth slows. Bloomberg understands the company will first attempt to break into the Hong Kong market, though plans are still at the preliminary stage. And that's your Bloomberg Business Flash. Danny.
All right, Leanne, thank you very much. Leanne Gerrans here in London. I want to look quickly at markets. We are looking at a 30-year yield, which continues to move higher here in the UK. Yields are up by about 11 basis points. That comes after a BOE, which is really just trying to get ahead of market pressures, considering that the training wheels, the continued bond buying ends on Friday, still not the best reaction. From the UK now to Russia and Ukraine, where central Kyiv has been hit by explosions for the first time in months, just days after an attack on a key bridge that links Crimea with Russia, a bridge that Russian President Vladimir Putin blamed the attack on Ukraine. Now, Kyiv's mayor said that Russian missiles have hit critical infrastructure in the city. For more, let's bring in Bloomberg senior reporter for international affairs, Mark Champion. So, Mark, we have Putin calling a meeting with his Security Council. What do we expect from it?
Yes, I mean, well, I think the shape of the retaliation is already showing. It's not just Kiev, but probably the largest set of missile attacks on cities across Ukraine since the war began. The targeting is very clearly on civilian targets, civilian infrastructure, Kiev's Central Park, a pedestrian bridge. These are, very clearly, often in the past, residential apartment buildings were hit, but they were somewhere in the vicinity of military targets. In this case, it seems clear that these are, deliberately targeted civilian assets and infrastructure. This seems to be the shape of the retaliation. We'll have that Security Council meeting, so this may just be the beginning. There could be further escalation.
Well, in the past, we have seen Ukraine attack arms depots and other transport infrastructure in Russia itself. So why is this bridge different, Mark?
Well, I think there are two aspects to that. One is that it is a very important piece of infrastructure for the Russian military campaign. This is the road and rail bridge that connects Russia to Crimea, which was annexed from Ukraine in 2014. And across that road and rail bridge comes all the military equipment, fuel, etc., for the Russian forces that are fighting in the southern part of Ukraine. So it's very important in that sense. But secondly, this was a personal project of President Putin. It's a 19-kilometer bridge, a very significant, piece of construction, and it was built after 2014 to lock Crimea into Russia. So both symbolically, personally, it's an embarrassment to President Putin, and it's an embarrassment for the Russian security services that it could have been executed, because it doesn't look as though this was a long-range missile. It looks rather that it was a truck bomb.
And, despite what Russia just perceives as escalations, despite Russia, which is deploying more troops, stepping things up, we still see Ukraine able to make headway. What's been making this possible?
Well, I mean, there's a sort of range of factors that go all the way from, NATO training to the enormous number of, quite modern weapons that Ukraine is being supplied by the West. But there's a kind of critical one, which is much more of a soft issue, but that is that simply that the Ukrainians have since 2014 learned to fight in a different way. They've had 8 years in the trenches to cycle almost, as many as 500,000 troops through those trenches. So all of those soldiers gained experience. The officers who, came up through the ranks during that period are now at the very top of the Ukrainian command. A lot of this, the Russians didn't have, and the Ukrainians at the same time decided to develop a really devolved style of command, which allows them to be much more nimble, make decisions more quickly, and whereas Russia still, is organized and fights very much as it did during the Soviet days.
Okay, Mark, thank you very much. That's Bloomberg senior reporter for international affairs, Mark Champion. Coming up, under pressure, Goldman Sachs shakes up its consumer banking plans. It's the big take. We'll discuss it next. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
To continue to bring down the inflationary pressures that people have. Certainly, what OPEC made the decision on this week to do was not helpful to us. The president was disappointed. We're disappointed as administration, but we need to continue to bring down those pressures. I mean, I think that, I had a long conversation in my office today. I certainly don't want to see the unemployment number go up. I like to see people working.
That's what the Fed is forecasting. Some people say that's the objective. How are you preparing for the pain that they're forecasting? And what can we do on the supply side when it comes to things like immigration?
Well, on the unemployment, we were talking for the last 3 months about seeing those numbers go down. And in the year 2022, we've had about 440,000 jobs per month. We're still seeing 263,000 people going to work today. This month, I should say, or last month, we're still seeing those numbers going on. So I think that that's something that is important that we continue to put those gains. We still have job openings. People are still looking for work. Obviously, we'd like to see the participation rate a little higher. I mean, that number went down a little bit this month. I think 0.1%. So we have to see what's happening there.
Clearly, the employee over the last couple of years is getting some leverage it hasn't had for a few years, a number of years, maybe even decades over their employers. You brokered a deal with unions in the last few months with freight rail companies, the 12 unions. I understand 4 of them have ratified the deal, Marty. Secretary Walsh, are you worried about the other 8?
No, I'm not. I mean, they're out there explaining, when I say they, the union leadership now and the bargaining committees are out there explaining to the members what's in those contracts. It was a very painful negotiation, not what I had, but leading up to me. 2 years of negotiation with really no movement. And I think that there's explaining to do in these contracts. And I look at these contracts, they're good. They're a good contract. I mean, it's 24% over 5 years, healthcare freeze cap, work rules change. It was a good contract for the employer and employee as well. So hopefully we can get the rest of these ratified in the next 6 weeks.
In the Rose Garden, the president said this: because of this labor agreement, those rail workers will get better pay, a 24% wage increase over the next 5 years, improved working conditions, peace of mind around their healthcare by capping the cost that workers will have to pay. Have the port workers on the West Coast, Secretary Walsh, asked for the same conditions?
No, I mean, I don't know. I don't know what they're asking for wages and benefits, but certainly those are all the conversations that are generally on the table. A little different negotiation. The West Coast port negotiation is a very fluid conversation. That both sides are at the table. They're both having conversations. It's a longer process than I anticipated, but that's just historically the way they've operated. They kind of take one segment at a time. I stay in close contact with both the employer side in the unions on the West Coast port, and both sides have expressed to me that they're still moving forward. There'll obviously be sticky issues that'll pop up every now and then, but nothing that's making me be concerned that I have to have a 20-hour meeting in my office about.
Labor Secretary Marty Walsh there speaking with Bloomberg's Jonathan Farrow. Now, a panel of German experts have just released a new proposal for gas subsidies. It would be subsidizing 70 to 80% of gas consumption. This plan would be broken down into 2 parts. It would be 80% subsidies for German private gas consumption, 70% when it comes to industrial. This would be part of a 200 billion euro aid package. So again, this is just subsidizing gas consumption. It does not go into detail about demand destruction, which of course we know would be necessary in order to get these prices into check. So again, 70 to 80% of gas consumption, that is the proposal for subsidies here. Now let's switch gears a little bit and talk about today's big take. And it's all about Goldman Sachs. Under pressure, it's dialing down its aspirations for the consumer market. CEO David Solomon is restructuring his consumer plans after cost overruns and missed profit goals. Joining us now is Bloomberg's Charlie Wells. Charlie, how big of a shift is this for Goldman?
This is pretty significant. So for well over half a decade now, Goldman Sachs has really been trying to crack the American retail banking market. We had one executive back in the day saying that he hoped that Americans would see Goldman Sachs as a, quote, lovable teddy bear. We know that Solomon himself got on a plane, as our story details, and tried to sort of come up with some sort of partnership with the celebrity Reese Witherspoon, who was thinking of offering her fans financial services, but dialing back of checking accounts, things like robo-advisory services that were supposed to be intended for a broad audience, but are now going towards wealth management clients, so a lot fewer clients.
What was the sticking point, the thing that made it so difficult for Goldman to get this off the ground?
A couple of things here, right? So first and foremost, it's incredibly expensive to execute retail banking right. So one study shows that it costs about $500 to acquire a new consumer, but then 15% in a year of clients, leave a bank. When you look at Marcus, the retail banking product offered by Goldman, that was supposed to break even this year, but what you see since 2016 is the bank spending $4 billion there. So it's expensive. The technology is really difficult to pull off. It's also just such a competitive marketplace.
Okay, Charlie, thank you very much. That's Bloomberg's Charlie Wells. And of course, you can read the big take going, NI Big Take Go on your terminal. Well, we continue to watch a euro that weakens. German bonds, some of the gains there starting to peter out with new subsidies being recommended by a panel of experts. The conversation and early edition continues next. This is Bloomberg.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, they're half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors? And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The Fed is on a one-way freight train, and they're moving very quickly.
I think we are headed for a collision of some kind or other, and we've just got to manage that collision carefully.
We are walking a knife's edge difference between the soft and the hard landing.
I think there is still some distortions that can be worked out.
We do expect the market to remain volatile.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The Bank of England expands its emergency support for the UK bond market. The new measures target the pension industry as the existing programme of gilt buying finishes at the end of the week. Chinese semiconductor stocks take a dive. They get hammered after the Biden administration limits their access to American technology. And Russia strikes back. Missiles hit Kiev and other Ukrainian cities after Vladimir Putin blames Ukraine for the attack on a key bridge to Crimea. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, in terms of risk appetite, we're still dealing with the after effects of that jobs report from Friday and looking ahead to the inflation print this week.
Absolutely. That inflation print is going to be critical, especially now as it seems that the market has abandoned that pivot narrative for the Federal Reserve. The jobs report really solidifying the idea that they are going to stay hawkish. And that was definitely evident in the Asian session overnight, where stocks broadly were lower, including China, which opened back up after a week-long holiday, and it was a negative reopening. The CSI 300 down about 2.2%. Now, in part, that had to do with the Caixin Services PMI number that is back in contraction territory. But the other big drag is technology stocks, specifically chip makers. After, as Anna mentioned, the U.S. announcing new tech curbs from U.S. technology, export controls tightening, and that weighed on chip stocks really across the board in Asia. One of the big examples being Shanghai Fudan Microelectronics, down 20% just in one day. Now, when it comes to the Chinese yuan as well, the PBOC still trying to make it stronger, setting a 28th day in a row stronger reference rate, and yet still weaker against the U.S. dollar, as it is a day of broad-based dollar strength this morning. Right now, the offshore yuan trading at 7.1461 to the U.S. dollar. And then, of course, following the jobs report of Friday, we saw Treasury yields moving up. You saw follow-through of that in the Asia Pacific, including in New Zealand, where the two-year yield moved up about 11 basis points. But, of course, today, Matt, no Treasury Treasuries trading because it is the Columbus Day holiday.
That's right. And nonetheless, it looks very risk off here because we see a big surge in the Bloomberg Dollar Index. S&P futures off about 0.5%. And of course, we had a terrible close down 2.8% on Friday. But remember, for the week, we were still up about 1.5%. We had gone down to something like 35.85 in the previous week, and we closed at around 36.36 last week. So we are seeing futures off to start the week today, and you're seeing the dollar index come back up. 1344 is the level here, and it's stronger against the pound, it's stronger against the euro, and you saw a real surge in the dollar against other major currencies about an hour ago. NYMEX crude right now is off about 62 cents a barrel, but still up to 92.02. This is another asset that kind of stealth rose during the OPEC cut. It didn't seem like we were seeing a lot of action, but if you look over the last couple of weeks, we're up from about $76, $77 a barrel in 2 weeks to 92.05 on Texas Intermediate. So not a bad rise, although it is bad, of course, if you need that fuel to power not only your vehicles, but also your factories, and that's why it's a headwind for stocks. Bitcoin also down more than 1% right now, 19,267, still holding in that very tight range, but as we get to a week where we're going to focus even more on global central banks raising rates, it's important to watch that. That's not good for the cryptocurrency. Anna, what do you see in Europe?
Yeah, we'll certainly have more on that crypto story, won't we, later on in the programme. This is the picture for Europe there, Matt. Looks negative. Germany actually outperforming, fairly flat performance today. Elsewhere, negativity across this European space. Interesting view of experts in Germany recommending a substantial package of support for users of gas over in the German economy. More on that a little bit later. But broadly speaking, we are negative across European equity markets. Let me show you some of the assets that stood out to me today, and we'll start with UK assets. And we've just heard that the UK government says it will announce its medium-term fiscal plan on October the 31st, and you may remember that it was delays to all of the full fiscal details, the full fiscal package, that was one of the reasons we saw a bond sell-off in the UK, in the gilts market. And so as a result, some of that news flow of interest to bond markets. We have, though, seen the 30-year yield spiking this morning, and we have seen a continued sell-off at the 30-year, 4.5% now the yield on the 30-year. The Bank of England confirming its policy, its emergency step-in, will come to an end at the end of this week, but they are adding another policy that will run till November the 10th, which will be specific to the pensions industry, a sort of window where they can place collateral with the Bank of England in exchange for cash, a broader range of collateral, not just gilts. Brent Matt has already talked about Renault, this stock up by more than 4%. The car maker, of course, has a big shareholding in its partner over in Japan, and they have confirmed they're in talks with Nissan that might result in Renault deciding to sell that and, of course, getting a pile of cash in exchange. Credit Suisse in focus, 1.7% higher. There has been talk about selling off a securitized part of this, the securitized products part of this business. PIMCO and others said to be interested, according to our reporting. We have to wait, though, Matt, until nearer the end of October before we get a fuller picture of the restructuring and the reshaping of Credit Suisse.
Yeah, absolutely. I think October 27th is the day. Let's talk about other banks, though. Central, that is. The Bank of England stepped up its measures to support market functioning as its emergency gilt buying measures entered their final week. The UK central bank said it will increase the size of its buying operations for the next 5 days to a maximum of $10 billion a day from $5 billion previously. Bloomberg's Danny Berger joins us now for more. So this is actually a massive amount of firepower. Will they use it all, though, considering they haven't used that much so far?
I was going to say, if what they've been doing is any indication, probably not. I mean, their maximum is $5 billion daily, or at least prior to this announcement it was. It's now double that, as you said. They've only used up $5 billion of this. That's all that they've bought from this market. So will this be enough? They're really trying to get ahead of the market, considering that this program is set to end on Friday. There's concerns of the bond market just settling off again, pensions being pushed yet again. There have been a lot of pension experts who have been warning that they haven't had ample time to get back to normal their liquidity buffers. So we have this longer term, at least until November, this temporary expanded collateral repo facility that's supposed to help ease some of those liquidity issues when it comes to LDIs. But we have seen a market that is concerned. After this was announced, we've seen some pain in the UK bond market, and it's yet again being led by the long end. Now, this recent breaking line that the UK is going to announce their fiscal plans and the OBR forecast on October 31st, rather. There is no 33rd of October, 31st. It comes at a time when we're supposed to get QT from the Bank of England. I mean, the timing here is really fascinating, and it is clearly a bond market that's concerned. Long end yields here are up by 10 basis points, Kaylee.
All right, Bloomberg's Danny Berger, thank you so much. Yeah, I vote for no months being longer than 31 days. All right, let's turn from the UK to China now. Chinese chip stocks slumped after fresh U.S. curbs on China's access to American technology added to disappointing starts to the earnings season for these companies. Charlotte Yang, our Asia equities reporter, joins us now for more. So Charlotte, tell us more about how Chinese investors are reacting to the latest measures from the U.S.
Yeah, so the latest U.S. curbs have been a selling trigger for Chinese semiconductor shares today. Just to show you how bad it was, the sector's bellwether stock SMIC has fell by most in 2 months. And also industry watchers are seeing these latest measures as can be a big setback for Chinese semiconductor sector and dragging like revenue growth for some companies as well as their technology development. And they say this could also be bad for the global semiconductor sector given the rising geopolitical tensions between China and the U.S.
Okay, so that's the specifics around China-US relations and these chip stocks. What is the broader sentiment for the Chinese stock market as we approach the Communist Party Congress? It kicks off over the weekend, of course, and it's something that only happens once every 5 years.
Yes, and so it's just a really bad Monday for China stock traders who have just returned from the week-long holiday. They're grappling with a slew of weak data from consumption, property, as well as latest COVID lockdowns. So sentiment is really weak now, and people are not adding any positions as we're heading to the Communist Party Congress, and they're just looking to find out more clear signals from where China is going with its COVID zero policies as well as stimulus policies.
All right, Charlotte, thanks very much. Bloomberg Charlotte Yang there talking to us about what's going on in China. Now let's talk about Ukraine. Missiles struck Kiev and other Ukrainian cities earlier today, 2 days after an attack on a key bridge to Crimea. Russian President Vladimir Putin accused Ukraine of committing a terrorist attack aimed at destroying civilian infrastructure. He called a meeting of his Security Council today. Mark Champion, our senior reporter for international affairs, joins us now for more. So, Mark, what do we know about the bridge and the retaliation?
Right. Well, I mean, the bridge was successfully attacked in what looks to have been a truck bombing. That requires, quite a lot of organization and was an embarrassment, really, given it was such a clear strategic target for the Ukrainians to hit, that the Russian security services weren't able to stop it. So it's also a very sort of personal attack on President Putin. He associated himself very much with the construction of this bridge after annexing Crimea in 2014. He wanted to really integrate it into Russia forever. So to have it, pieces of it dropping into the sea is really a sort of personal affront to him. And, what we're seeing now in Kiev and across the country are missile strikes on a level that we haven't seen before. Kiev hasn't been hit, central Kiev, by missiles on this scale for months at this point. And also the nature of the attacks, these are very clearly directed at civilian targets, a pedestrian bridge, a park, very popular park, these kinds of things. In the past, when residential buildings were hit, oftentimes, they were in the vicinity of military targets so that they might have been hit by mistake. But in this case, there is absolutely no mistaking it, infrastructure and civilian targets.
Now, President Zelensky has been speaking to some European leaders, and he says he will address the emergency G7 meeting about the attacks. What are we expecting from the Russian side then, Mark? It's been fascinating to watch what's going on in Russia, the level of criticism that has been tolerated in Russia of the regime or of military leaders. What happens next?
Right. Well, I mean, there are two things to be said about this. I mean, Putin is coming under criticism within Russia, but it's not necessarily the kind of criticism that Ukraine or the West would like to see. This is coming from the nationalist and ultra-nationalist right in Russia, and they are attacking Putin for not conducting the war with enough vigor. So they're not against the war itself. They're very much in favor of the war, but they are attacking him for being too weak in its pursuit. And they are constantly talking about, the fact that we haven't really started fighting yet with all the resources that we have. They're pressing him to escalate. In some cases, they're, pressing for escalation to a tactical nuclear weapon as well. So not something that we want to see. There's no sign at the moment that Putin is backing down in the face of international criticism. On the contrary, that we will have to wait and see what happens at the Security Council meeting that he called for today.
All right, Bloomberg's Mark Champion with the latest in geopolitics. Thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. And I have to begin with Rivian. After over the weekend, it announced it is recalling 13,000 vehicles because it discovered a minor structural defect. That is nearly all of the EVs that it has delivered thus far. So that is weighing heavily on the stock in pre-market trading, down about 6.5%. And you have another automaker lower as well, Ford. This is after getting downgraded from neutral to sell at UBS. The analysts there talking about how Ford has one of the least attractive risk-reward profiles in the space. As a result, it's down about 4% before the bell. And another stock to note, and this is related to the U.S.-China chip story, is Lam Research. This is, of course, a U.S. maker of the equipment used to make semiconductors. It gets about 31% of its revenue from China, so perhaps those restrictions could hit that portion of its business. And as a result, it is down about 2.6% before the bell, Anna.
Coming up on the program then, Kaylee, we'll talk to Karim Chedid, BlackRock Head of Investment Strategy for iShares EMEA. What is the European strategy at the moment? A lot to say when it comes to the European gas story, the European energy space, and indeed what's going on in UK gilt markets as well. We'll get Karim's view shortly, and we'll discuss the state of crypto with Tim Grant, Galaxy Digital's Head of Europe. He'll join us shortly. Plus, ditching the dream of consumer domination after an expensive push into retail banking, Goldman Sachs is now reeling in its plans. More from today's big take story ahead. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg Surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blink.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in Focus, Thursday on Bloomberg.
welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller with Kaylee Lyons here in New York, Anna Edwards with us out of London. Now, as we focus in on inflation, of course, energy price is a huge part of that. I'm looking at the week that we had in crude. It's down a little bit today as the dollar rises up, but last week was the strongest week that we've seen in 7 months, with OPEC cutting 2 million barrels of production. At least that's the headline cut figure a day. And even as we are concerned about a decline in demand due to an economy that should be slowing down, at least as central banks around the world raise rates. Eddie Vanderwalt joins us from Bloomberg's Markets Live to talk about what this means and what we should expect going forward. Eddie, are we going to really see a drop in demand?
We may well do. Look, I think, if the world economy heads through a recession, then, absolutely oil demand should fade away. But but you know what? I think for me, the big takeaway here is that the long-term story for oil is extremely bullish, because on the one hand, you've got OPEC trying to, or announcing that 2 million barrels a day cut, which isn't even a 2 million barrels a day cut. They don't have that much to cut. At the same time, we're not seeing shale picking up at any way, shape, or form, even at this $100 a barrel level. That tells me the supply side just isn't there. It's not there to supply the oil that the world economy needs if this is a short, sharp recession that we see.
And what about the broader energy outlook? Good morning to you, Eddie. For Europe at this point, a difficult winter in store. We heard from an advisory group to the German government this morning recommending the state subsidize as much as 80% of natural gas consumption for households and companies as part of that existing €200 billion package. Yeah, you know what? The
natural gas situation in Europe is extremely interesting. What we've seen over the last few weeks is that the short end, the contracts for near-term delivery have come down significantly. We're talking about a December contract that's down 50%, over the last couple of months. What that tells me is that the market is assuming that perhaps, given mild winter, Europe should have enough supplies. But at the same time, we're seeing the longer end of the curve. So next December's contracts and further out, above where they were a month ago, which tells me that the market says Russian supply is not coming back for next year either.
Eddie, finally, just on a broader macro scale here. Obviously, early last week, we were talking about the possibility of a Fed pivot. The jobs report on Friday seemed to throw a huge bucket of cold water on that. We await inflation later this week. Where are we on that pivot narrative now?
Yeah, absolutely. You know what? I wanted to buy into that pivot narrative. I wanted to be the bull in, I don't know, the China shop. But it's disappointing that particularly the participation rate ticked lower, because a lot of that narrative is built on the idea, the bullish narrative is built on the idea that workers are going to come back to the economy and push down the inflation story. And now we saw a little bit of a wage inflation coming down as expected, but the participation rate falling, and I think that's worrying. But really, the big story is CPI as we move towards the end of the week.
Absolutely, CPI, the next data print to really watch after the jobs report from Friday. Eddie, thank you very much. Eddie Vanderwelt of Bloomberg Markets Live. And for more market analysis from Eddie and the rest of the Markets Live team, MLI Vigo is the function to use on your Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
We make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them, and so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value, and the kind of transparency that they want.
Are you seeing a labor shortage right now, and what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In Germany, an advisory group is urging the government to subsidize as much as 80% of natural gas consumption for households and companies early next year. It would be part of a $194 billion aid package. The German government will review the recommendations and issue a decision in the coming weeks. A mega yacht linked to one of Russia's richest men has docked in Hong Kong's harbor. That's led the U.S. to warn the city that assisting sanctioned individuals could threaten its status as a financial hub. The yacht, called Nord, is tied to Alexei Mordashov, who was sanctioned by the EU, U.S., and U.K. following Russia's invasion of Ukraine. Meanwhile, Taiwan's president says there will be no compromise on its sovereignty or democracy. That came hours after China hailed a proposal from Elon Musk that the self-ruled island adopt a Hong Kong-style governance model. Taiwan's president said that Beijing should not make any misjudgment on account of Taiwan's vigorous democratic system. And Allianz chief economic advisor Mohamed El-Erian is blaming the Fed for what he calls the very high risk of a recession. El-Erian told CBS that the U.S. economy is on a bumpy journey to a better destination. But he again warned that the Fed could hurt the economy by slamming on the brakes to fight inflation. And Matt, of course, this is something El-Erian has been sounding the alarm on for some time, the idea that the Fed moved too late and now there's going to be consequences of that delay.
Yeah, exactly. I mean, I think, honestly, this is nothing new. The Fed moved too late a long time ago. They can't really, turn back the clock and do it again. So, they've got to deal with the situation there and now. And Larry Summers said on Friday to David Weston that the only way they can do that is to continue raising rates. And if they break something, we'll have to deal with it when they do.
Yeah, even if it results in financial instability, which ties into what we talked a lot about last week. Coming up on this program, we'll put these questions to Karim Chedid, BlackRock Head of Investment Strategy for iShares EMEA. What are the flows tell us right now? What does he see? We will talk to Karim shortly. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Bank of England expands its emergency support for the UK bond market. The new measures target the pension industry as the existing programme of gilt buying finishes at the end of this week. Chinese semiconductor stocks take a dive. They get hammered after the Biden administration limits their access to American technology. And Russia strikes back. Missiles hit Kiev and other Ukrainian cities after Vladimir Putin blames Ukraine for the attack on a key bridge to Crimea. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Matt, risk appetite taking a hit from Friday. That continues to be the vibe this morning in Monday's markets as we gear up for that inflation print later this week.
Yeah, huge drop we saw on Friday. At the end of the session, we were down 2.8% on the S&P. We're off again in terms of futures now, just about 1/3 of 1% so far, 4 hours away from the market open. So a lot could change between now and then, but we got some headwinds, namely a stronger U.S. dollar. The dollar index up 1344, so gaining against most major world currencies, including the pound and the euro. And even though crude is off, it's at a relatively high level, right? This is Text Intermediate, not Brent. And we're seeing it trade at $91.96 a barrel. So yes, it's down 68 cents, but it had an incredibly strong week last week, the strongest in 7 months. And that also is a headwind for stocks. Bitcoin coming down about 1% right now, 19,286. As the dollar gets stronger against other assets, it's no surprise that you see a little bit of weakness in Bitcoin, but we're still hanging around in that $20,000 range. Kaylee, what do you see in terms of pre-market movers?
Well, in addition to Bitcoin and crypto, I know there's one other thing you like talking about, Matt, and that would be cars. So I'm taking a look at all auto stocks in pre-market trading this morning. The first being Rivian, which is, of course, an EV maker. It is recalling 13,000 vehicles after it found a minor structural defect in some of them. But that is almost all of the vehicles it has delivered thus far. So that is weighing heavily on the stock, down about 7% before the bell. Then you also have two movers related to UBS analyst action. UBS cutting shares of Ford to sell, talking about a negative risk-reward profile. Ford is down about 4%, and then also UBS downgrading GM to neutral, saying that the strong EV story is unlikely to drive the stock higher in the next 6 to 12 months. So GM is down about 3%. And finally, I added Tesla on here as well. You are seeing the losses compounding after last week. The stock was down 16% last week, and that is falling further this morning, down about 1.5% before the bell, Anna.
I also have a car focus for Matt, Kaylee, but we'll come to that in just a moment. We've got Stocks Europe 600 down 0.3. We're not always so nice. Down 0.3% on the Stocks Europe 600. So picking up on the losses of Friday. Yes, we were down in Europe, but the US was down more. We catch up with them in today's session. Adding into that, of course, weakness in US futures, and that is meaning it's heavy weather for European stocks today. The UK 30-year yield, once again in focus. It was above 4.5% earlier on this morning, and it has been ticking up a little bit despite the action that we've seen from the Bank of England at the long end of the gilt curve. But now coming down, it has come down a little bit, and partly at the same time, at least, as that confirmation we got about the fiscal plans and the OBR statement, all of that will come on October 31st, which might come as a welcome relief for the market if it thinks it's still a little bit in the dark as to how those unfunded tax cuts are going to be funded here in the UK. This is Renault then at 31.96 is where it trades, up by 4.2%. They have confirmed they are in talks with their partner over in Japan, that is Nissan, and they could be about to sell their stake in Nissan, so as a result the stock is higher. And Credit Suisse, their structured products business in focus, it has attracted interest from the likes of PIMCO and others, according to our reporting, and this all coming ahead of a big reveal, Kaylee, on October the 27th around their strategy.
Yep, we will be looking forward to that in just a couple of weeks. Meanwhile, this week, Anna, we're looking forward to the kickstarting of earnings season here in the U.S. Some of the big U.S. banks will be reporting starting Friday with J.P. Morgan, setting the stage for an earnings season that our guests are gearing up for. Here's some of what they have told us about how it will impact the market.
Earnings expectations have fallen sharply for the third quarter. We believe that they're going to be better than expected. The official rate now for the third quarter from FactSet is a 2% gain.
Connection
with
lost.
Several sectors in the negative territory. We think that 2% is too low.
As much as I hear people tell me the consumer's in good shape, they're not. In the U.S., the savings rate's decade low, credit card usage is decade highs, and it's definitely a deceleration.
In the U.S. is nothing that any of us like to write home about, so to speak. Nevertheless, the economy is on a more solid footing than most places, and earnings still look attractive.
The next move lower will be a more realistic assessment of earnings by analysts.
Going into the third quarter earnings season, if we have some positive surprises, the market's looking for good news, I think it'll react.
Joining us now for more is Karim Chedid, BlackRock Head of Investment Strategy for iShares EMEA. Karim, what are you gearing up for this earnings season? How high is the risk heading into it?
Yes, thank you. I mean, you can see that there's some consensus building around earning bar being still too high to clear. And when I look at the earnings season and I look at how analyst downgrades have begun to come through, there could be more to go. You know, we see that earnings expectations are still a tad too positive. And when we think about the inflationary pressure at the level of input costs that are still coming through, we like to focus on sectors that are more resilient to those cost pressures in this earnings season. So looking at the likes of technology and healthcare.
Okay, so there could be a lot of, good morning to you, Karim, there could be a lot of focus on specific parts of supply chains and specific sectors and where margins manage to remain robust. Let me ask you about Europe then in this context. Looking at some of the data that you do, positioning in European equities continues to be extremely short, you say. What does that tell us going into the earnings story? I mean, the geopolitical risks are plain to see.
Yeah, I mean, it tells us that we have seen signs of capitulation when it comes to European equities. Investors have sold the bulk of their positions throughout this year, and we're seeing extreme short positions both in the ETF space as well as the broader fund flows space across ETFs and mutual funds. Very extreme shorts in European equities, which means that European equities are really priced for the worst case scenario. You know, a lot of bad news is already in the price.
Okay, that's interesting. Does that mean there isn't a further leg down on earnings disappointments in Europe, but there might be elsewhere?
Well, that's where it gets interesting. When you look at the earnings estimates for Europe, they're still too positive. In fact, they're still more positive than US earning estimates. So on a price to earning level, there could be more pain in European equities because valuations are actually not that cheap, given that the E part of the PE can still come down. But from an investor positioning level, it's extreme short.
How would you play this? You've got obviously one of the biggest paddocks of ETFs in the world. What would you do?
So when we look at ETF flows in this context, it's been all about fixed income in the past month or so. We're seeing some signs of significant de-risking from investors. So one stat I'd share with you is of overall global ETF flows across the industry in September, 61% went into rates exposures. That's pretty safe haven to me, and most of that has gone into the short end of US Treasuries. And the ETF industry is celebrating 20 years of fixed income ETFs this week, so quite a milestone here, and the industry has evolved a lot. But it's been all about fixed income and really safe haven fixed income in this environment.
So considering that, I think you have $3.5 trillion of ETFs in your stable. What kind of growth do you see for this industry? I mean, in a year when M&A has fallen apart, we've just seen the bond market kind of shut down. There have been no IPOs of note other than Porsche. There continue to be a ton of ETF launches. Does this growth continue, or does a recession slow us down?
So it's a great question, and I think I'll take it asset class by asset class. When we look at fixed income, as I said, 20-year anniversary this week, the adoption of fixed income ETFs is on a rising level. And in fact, at BlackRock, we forecast that by 2030, the $1.7 trillion of assets sitting in fixed income ETFs today will become $5 trillion. So we see a lot more room for further adoption in fixed income ETFs. And in fact, during periods of market volatility, like what we've been seeing in the past few weeks, we see a go-to to fixed income ETFs in terms of really increasing trading volumes and liquidity providing. Now, when we look at equities, I think, you alluded to this with the launches. I think we're seeing increasing focus on more precision type exposures. So whether it's at the level of more selectivity on a sector and factor exposure level, or whether it's on a thematic level, we're seeing more and more specific exposures that investors are going to play selectivity in equities.
Karim, thank you very much for joining us. Karim Chedid of BlackRock. Coming up on the program, we will think about tighter monetary policy and its impacts on a different asset class. We'll talk about crypto. Tim Grant joins us, Galaxy Digital's head of Europe. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Person who now looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Now, Bitcoin is falling along with risk assets today after a strong September jobs report re-solidified expectations for continued hawkishness by the Fed. Joining us now to discuss, Tim Grant, head of EMEA at Galaxy Digital. Tim, very nice to speak to you this morning. Let me ask you how cold the winter gets for crypto then, because, you used to look on the social feeds of the crypto community and see plenty of memes about money printing by central banks. Well, that money printer isn't quite whirring in the way it used to be. So how difficult does it get for crypto assets?
Well, it's a tale of an idiosyncratic crypto element and an overall macro element. I think what's been interesting this year, and you've commented on it a little bit already, since the beginning of the year, sort of a maturation of this asset class when it started to trade. Bitcoin traded, as all intents and purposes, like a NASDAQ stock. So I think that started to change the way in which the market looked at this asset class. You could see the institutionalization happening. It's not a retail asset class anymore. And so the macro backdrop is really affecting us just as it's affecting every other asset class, just as we've seen in your graph there. What does that look like going forward? How cold does this winter get? Well, I think it's highly dependent on the macro situation, the Fed, policymakers in Europe, policymakers in the UK. Now, idiosyncratic crypto elements, we've seen plenty. You've reported on plenty over the last few months. We think the leverage is out of this system now, for the most part. We don't see any massive shoes to drop. We saw a hack last week, yet another hack on a bridge. Will we see that kind of thing again? Probably. Will that really materially affect this asset class?
Okay.
No, I don't think so.
Okay, so a lot depends on the macro and on the regulation, and you've talked quite positively about the EU legislation that we've seen to this point, and maybe the US, maybe the UK are behind on this one. What is it that's attractive about what the European Union has done here?
Well, look, I think the EU's just made a huge step forward last week. Just Wednesday, the EU Council effectively locked in stone the text for what's called MiCA or MiCA, the Markets in Crypto Assets Regulation. Now, why is that so significant? 27 states across the entire 330 million population bloc have agreed finally, after a long time and a lot of uncertainty over when this would happen, on the text. And that means that roughly, towards the end of this year, early next year, we'll see that get ratified and go into the official register or official journal. And then in 2024, we're going to see the opportunity for anyone who's regulated in any state to do business across the entire state. Now, this changes dramatically for corporates and businesses who are in this space, the opportunity set. And I think it does kind of catapult a little bit beyond the US, which is still fragmented, still thinking a lot about it. The SEC and the different agencies over there are still debating what to do, and there's obviously a political element there.
Yeah.
Quietly, the EU has gone forward and created something that gives us certainty going forward.
Okay, Matt, jump in.
What happened to NFTs, Tim? I mean, non-fungible tokens were the hottest thing from musicians to Bored Apes, and the values seem to have just dived even further than the rest of the crypto space. Are they coming back?
Well, look, the NFTs, just like a lot of elements in this space, they go, there's boom and bust cycles. There was a lot of activity in this last year, as everybody knows. An awful lot of money flowed into the sector, a lot of celebrities getting behind it, and that always causes a little bit of energy in the space. Now, of course, that's deflated now. We've seen NFT prices in general go down pretty materially. What we're seeing, though, on the back end of this, and this is actually true in non-FT crypto markets too, NFT crypto markets, we're seeing institutional adoption. So we're seeing big brands, luxury brands come into the space. There's a lot of talk of the metaverse. We're in the collision of the metaverse and NFTs. And what we're seeing in the background is some projects that really, we believe in the next couple of years are going to kind of bring this back to the fore, but with something a little bit more tangible, something that's more experiential, something that really touches the consumer in a different way. So yeah, we do see in the long run a more sort of constructive backdrop to the NFT story. Matt.
Tim, you've mentioned institutional adoption a few times now, how it is larger institutional players now in the space versus just retail as it was before. And I'm wondering if that may be why we have seen these assets so range-bound for months now. If you look at a chart of the Bloomberg Galaxy Crypto Index or just one of Bitcoin, I mean, for about 4 months since mid-June, it has been essentially a straight line with very little movement up and down. Do you expect that volatility will come back into this asset class, or is that institutional play there a stabilizer?
Well, look, I think it's definitively a stabilizer, and if you look at the chart that's up there right now, you'll see there was the material downswing we had around about the Terra Luna collapse.
interesting to note that when that happened, perhaps somewhat counterintuitively, we saw a big onboarding demand from big institutions, big traditional hedge funds, banks, asset managers, endowments, pension funds, and we're still working through that backlog of onboarding. Now, why would that be? You might think that as prices went down, they'd think, oh, hang on, let's step back. Well, no, they've been working on this for a long time. This is arguably a better entry point. So yes, you are seeing more institutional participation in the space. It has created a two-way market. I think also notable is the derivatives market, a real barometer of the growth of any asset class is how significant the volumes end up being in derivatives. We're probably the biggest balance sheet in derivatives in the world for crypto derivatives, and we're seeing healthy two-way flow across the board. Now, that's growing. Let's not over-egg the pudding. That's growing. But in terms of volatility, back to where we started, depends on what we see from a macro perspective. And look, there's always that idiosyncratic component. But yeah, it's going to come back. And I think, look, we're seeing the hedge funds trade healthily right now. They're making money in the same way that they're making things like Frontier FX and Frontier Rates at the moment. It's very much the same idea.
Tim, thanks so much for joining us. Great having you in the studio there in London. Tim Grant, head of EMEA at Galaxy Digital, talking to us about crypto. Tune in, by the way, to Bloomberg Crypto. That's every Tuesday at 1 p.m. New York time, 6 p.m. in London. Our weekly show covers the people, transactions, and technology shaping the world of decentralized finance. This is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology.
Welcome to Bloomberg, the lineup. We have some breaking news out of Oslo, Norway. The Nobel Prize in Economics has been awarded to 3 individuals, one of them being former chairman of the Federal Reserve, Ben Bernanke. The other 2 winners are Douglas Diamond and Philip Dybvig, who have done work on bank runs and bank research. The 3 of them, Bernanke, Diamond, and Dybvig, have been awarded the Nobel Prize in Economics over that bank research. Very interesting to see a former chairman of the Federal Reserve winning this prestigious award, Matt.
All right, we'll continue to cover that. Of course, you're going to hear a lot about it probably from Tom Keene on Bloomberg Surveillance next, so stay tuned for more on the Nobel Prize for Economics. Now, in terms of banking, David Solomon once predicted Goldman Sachs would be a leader in retail banking like it is on Wall Street, but expansion proved expensive, and the bank is now reeling in those aspirations and the resources dedicated to the project. That's the topic of today's Big Take, which is a very big take on Goldman Sachs and Marcus Bloomberg. Sri Natarajan wrote the story and joins us now early. Thanks so much for coming in the studio, Sri. Great story. And yeah, I mean, I think people have been waiting years for Marcus and for Goldman Sachs' consumer effort to work out, assuming it would because everything else they do works out, and it hasn't.
And that was the interesting thing, right? This is a bank that's been around since 1869. For much of its history, its prowess has been in dealing with hedge funds, in dealing with the big corporations and the big institutions. So when they decided to make the jump into Main Street, it was a big deal. It was a symbolic move, and everyone was curious to say how it would pan out. 5-6 years in, a lot of money has been poured into the effort. The results are not there just yet. And you can see in a moment of severe pressure, the bank is reeling in those aspirations and saying, maybe we did make a mistake. Maybe we did have to choose a narrower lane and try to make sure from that point on the business is accretive to returns. The way they went wasn't quite it.
So now they're trying to reshuffle things around and restructure. What will that ultimately look like?
Look, some would argue that what they're doing now is actually playing to their strength. Instead of going direct to consumers, instead of swarming the airwaves with jingles and hiring reality TV show stars to sell their product, they're actually saying, we will market this product through our wealth channel. We already have a workplace offering. You have access to some of the biggest companies and their workforces. Try and offer these consumer products among the bouquet of offerings you already have for them. That may be a better bet for Goldman Sachs than going direct to Main Street.
Sri, I'm sure you can chart the history of the retail offering at Goldman Sachs quite a few years back, can't you? And I remember post-financial crisis, there's a lot of emphasis on banks securing retail depositor bases. Have the arguments for really developing and investing in this side of the business, have they changed? Is that part of the rationale here?
No, that's a good question, because the one part of the consumer business that always had fans was the part of the business that was sopping up deposits. The high-yield savings account in Marcus already has more than $100 billion in deposits. That's a good business because no one can argue against the fact that the bank needs a cheaper source of funding and a diversified mix of funding, and this is just it. So whether it's through the consumer deposits or their newfangled transaction banking business, which does the same with corporate deposits. So that argument hasn't changed. But the problem was they were trying to do too much at once, as they themselves acknowledge, and that is why they had to take a breath, restructure, reorient these operations, and hope that the detractors will go away.
All right, Sri Natarajan, thank you so much for waking up early this morning for us, and thank you for that big take. You can find it on the Bloomberg terminal as well as online. Now let's take a quick look ahead at what is coming up for the rest of this week. China markets are back open for business after a week-long holiday. Wednesday is going to be a busy day for the UK Prime Minister Liz Truss as she directly addresses her mutinous rank-and-file Tory lawmakers in an attempt to reassert her authority. We'll also be getting some GDP data. We'll be getting that crucial U.S. CPI data on Thursday. U.S. retail sales will be on Friday, as well as U.S. bank earnings kicking off on Friday. And on the subject of banks, Matt, of course, we just saw the Nobel Prize in Economics awarded to Ben Bernanke, Douglas Diamond, and Philip Dybvig for their research on banks as well as financial crises. And of course, that award coming out of Stockholm today, Matt.
Yeah, absolutely. We're going to focus in on that. Are we going to get the Nobel Peace Prize today as well?
We got that on Friday.
Oh, we got that on Friday. Okay,
yes.
So all the Nobel Prizes, are we all done as economics? Does it round out the... We don't know.
don't know the answer to that, but I do know that these three individuals will be splitting the prize for this year, Anna.
Well, it's very exciting.
It is.
It's very exciting for them, I'm sure. That is it for Early Edition. More surveillance is ahead. They'll have plenty more focus on the macro story. Bill Dudley, former president of the New York Fed, joins. Also, they'll keep across the geopolitics, the latest developments in Ukraine and Russia. This is Bloomberg.
We anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future.
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The Fed has kind of entrenched themselves and kind of like, no matter what happens, we're going to do it.
They're raising rates extremely quickly in order to fight inflation.
Yes, monetary policy operates with a lag, so we're waiting on those lags.
We do expect the market to remain volatile. You know, these rallies that we're seeing, we continue to expect them to fade.
We are walking a knife's edge, difference between a soft and a hard landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Futures negative 0.1% on the S&P. This week, Bramo, it's all about CPI.
Is it? I mean, it's CPI. It's also earnings. It's also University of Michigan sentiment on Friday. Come on. But yes, okay, CPI is going to be the big event. But there's a lot of other issues as well.
You expect me to take that opening seriously?
Yes, I was.
You, Mitch.
Well, look, there was a moment. There was a brief moment when we were actually talking about this as like the key, as a key issue. No, honestly, CPI will be incredibly important, in particular with core inflation. how much does it rise? Do we get that year-over-year increase with some of the base effects not taking over with the core reading, even if you do have peak inflation on the headline CPI?
CPI hijacks the conversation around the Federal Reserve's next move, whether it's 75 or whether it's 50. On the earnings front, JP Morgan kicking things off on Friday morning. I think we've had warnings this morning from Morgan Stanley, from David Costin over at Goldman Sachs. Everybody just chop, cutting them going into earnings season.
The why is going to be interesting. How much is this a currency-adjusted issue? How much is this a dollar actually exacting a lot of pain over international companies? About 30% of revenues from U.S. companies come from international commerce. How much does that get really crimped and push people toward more domestic-leaning companies? This is an increasing theme that I'm seeing in some of the notes.
The outlook for global growth, the numbers that come from Tom Orlick and the team up here at Bloomberg Economics, 3.1% for this year in 2022, 2.4% in 2023, just decelerating through the next 12 months.
Where's the growth going to come from?
That's the problem. Europe in recession this year, US in recession next year seems to be the base case for so many people.
And then China, right, the elephant in the room, over the weekend came out with some data that was negative, right? They opened up, they reopened, and they showed that some of their services data actually decelerated, declined at the fastest pace going back for a month. So even though you do have a situation where perhaps the U.S. is hanging in there, the rest of the world, there really isn't that node of growth that's going to come out.
It was good news, bad news Friday.
Yeah. It was. Yeah. I mean, I hate doing it too because it's so simplistic and what does it actually mean? But the bottom line is the more the economy has momentum, the more the Fed will have to do.
Bottom line.
Bottom line.
For now, and then we start talking about the why the Fed is backing off. They're backing off because of supply side, positive evolutions on the supply side. That's a good thing. They're backing off because they need to damage demand or they've done that already. I think that's problematic.
Okay, it is problematic. The reason why I mentioned earnings as incredibly important in addition to CPI, yes, I agree with you. CPI is the main event this week, but earnings, the reason why...
It took you 2.5 minutes, thanks.
Well, no, that's to undermine your premise. I do think it is CPI week of October, but I do think that there is an issue with earnings. How much is the strong dollar impacting earnings in a negative way that's going to cause the Fed to say, wait a second, suddenly the dollar isn't just your problem, it's also our problem? When does that become a bigger part of the conversation? And how much does earnings really trigger that at a time when, yes, you want to see weakness, but you don't want to see decimation of an economy where you do have a lag effect of some of the rate hikes that we've already seen.
Any thoughts on Bernanke sharing the Nobel Prize in economics?
You're basically like, you're gonna divert away from CPI. I'm gonna throw you under the bus to talk about Bernanke. I mean, I think that right now the Nobel Prizes are becoming increasingly political. What is the political message from Ben Bernanke?
Oh, you think this is a political decision?
Well, what is the decision to have somebody who is a high-profile policymaker win a major prize in economics? I'm just curious about that.
I wonder if it's premature, since we're unwinding the QE of the last 10 years right now, whether we should wait before we dole these out.
Which is the reason why I'm saying it's highly political. It's sort of this question of someone who is still active and their policies are still very present in the public discourse. That becomes a more politicized prize. I mean, I think that these are all fantastic behemoth minds in the economics profession, but they are incredibly polarizing when they have such a direct effect on current economic theory and economic reality.
We agree with each other. Futures unchanged on the S&P. We're down about 0.1%. No real drama here in the bond market. The US Treasury market closed for Columbus Day. Looking at a German bond yield, which is down by around about 4 basis points. The bund yield, 2.15% on a 10-year. The 10-year yield in Germany, just like the 10-year Treasury yield, climbing for 10 consecutive weeks. Ridiculous. Euro-dollar 97. Euro-dollar 97 and negative 0.4%. And crude, after a monster rally last week, crude is down about 0.5%. WTI last week, Lisa, up 16.5%.
And we heard over the weekend Janet Yellen speaking on a number of different outlets talking about how negative this was for the world and possibly for what happens in November. What I'm watching today, I mean, this is going to be a really important week. It is CPI week. And to your point that you started the show out with, yes, it is that. I just also think it's important to look at earnings. Today, we have an incredible amount of speakers because nothing else is happening because the bond market is closed. And so why even show up? Fed Speak includes Chicago Fed President Charlie Evans at 9 a.m., Fed Vice Chair Lael Brainerd at 1 p.m. Both are speaking at the NABE conference in Chicago. ECB Speak, Chief Economist Philip Lane speaking at 9 a.m. and at the online ECB conference on monetary policy. Very curious to hear what their take is, especially whether they start to price in recession, considering that everyone basically says it's a base case in Europe, but they are still not including that in their forecasts. And today, the 2022 annual meetings of the IMF and World Bank kick off in Washington. From 8:30 to 9, there is going to be a conversation with IMF Managing Director Kristalina Georgieva and World Bank President David Malpass. I'm curious to see how much the focus really turns to the developing world. That's what we heard over the weekend from Janet Yellen, saying that they are incredibly concerned about emerging markets in the face of the strong dollar, but also in the face of some of these economic headwinds that usually hurt the lowest income nations the most.
People really going after him about climate change, aren't they, at the moment?
I don't understand exactly how this is becoming a distraction. I mean, just to sort of editorialize, because he basically came out and questioned some aspects of climate change, and then people called for him to step down. And then he pushed back and said, look, I didn't know enough to really be saying at any point, and people saying, you're just hiding an agenda. The whole point is how politicized some of these bodies that have to be providing important aid at a time of real change.
Well, I think nominated to the World Bank by the former administration, ultimately picked by the Trump administration, and there seems to be some tension over it with the current administration. I mean, that seems to be the elephant in the room, isn't it? What's wrong with someone turning around and saying, I'm not an expert in something? What's wrong with that? When did that become a problem?
And again, this goes to this issue of politicizing bodies that have to act internationally. And the U.S. as a leader at a time when it is splintered and it is divided, and it becomes a real challenge at a time when there needs to be some sort of leadership to handle the next crisis.
Kind of refreshing for someone to turn around and say, I'm not going to talk about it, I'm not an expert in it. I mean, it's kind of refreshing, isn't it?
I'm not an expert in it.
I'm not an expert in it either. Linda Dussel isn't either. She is on the markets, though, senior equity strategist at Federated Hermes. Linda, fantastic to catch up with you. Let's talk about energy. 16.5% move on crude last week. The underlying commodity had a massive move. The energy equities have had a massive year. Why are you sticking with them, Linda?
Well, good morning. Thanks for having me today. Yes, we've been really bulls on the energy patch for several years now, and the earnings, first of all, speak for themselves. This is what's really been driving the market in terms of the earnings, is the energy patch itself. So if you look at the valuations of energy stocks, they are as cheap as they've been for really over 30 years on a PE basis. So they're inexpensive versus the momentum that they have. And whatever pullback we saw earlier this year was for concerns of a global economic recession. And that has to fight with the supply problem. So you have to pick your side there, and we picked the supply side.
Linda, how much are you looking at more small caps or domestically oriented U.S. companies in the face of some of the headwinds from the strong dollar?
Yes, I know the strong dollar is a big problem, but it's the multinational companies are the strongest positioned ones. Those are the ones that you would own heading into an economic slowdown or into a recession. Small caps, we like small caps. They're not exposed, as you've said, to a strong dollar, but that is basically an early cycle play. So we really are more in favor of large cap stocks. They're still the ones that are generating the highest profit margins. They're gushing cash, and even in the face of what's been a very strong rise already in the dollar, we're all fingers crossed that this advance in the dollar will at least slow down and maybe pull back some. For us, the biggest concern with the dollar is what it's requiring other central banks to do in terms of tightening when their own economies are looking to head into potentially severe recessions and then a financial accident.
Linda, this is going to be a tremendous week. We were just talking about CPI coming out on Thursday in the United States. We also have earnings kicking off on Friday. What will be the most important thing for you in terms of how you plan to adjust your allocations heading into year end?
Well, I think that the Fed is, with the jobs report, is really indicating that they'll probably continue on hiking in a more aggressive fashion. So the next thing to really worry about is the CPI in particular, and that core part of the CPI, where a third of it is the owner's equivalent rent. We've seen prices increasing dramatically, whether it's rent or for purchase, and lots of talk about a recession in the housing market and about house prices coming down. But indeed, the vacancy rate for rental or for home for home purchases is at a 40-year low. So it's still very, very strong. CPI will be extremely important. It'll be important also to watch retail sales. And of course, Amazon Prime Days are this week as well. We think that the consumer is extremely strong. So, just over the weekend, I'm reading the economy's weirdly resilient. It's not weird. People have jobs. They've got a lot of jobs. They've got a lot of money in their pockets. That's what really gets us going as consumers. If we have a job, we do.
Linda, that's the good news. Thank you for being with us. Linda Dussel there of Federated Hermes on this equity market, on the economy as well. We're doing the Mets today. Or we ignoring it?
No, we're ignoring it.
It didn't happen.
Didn't happen. No,
Didn't
not
happen.
at all. My sons were actually at the game.
They were at the game.
And they came home late, being really angry. And
who are they angry at? Just like the state of the world, life?
State of the world. Okay. I mean, no, that year situation and how there was cheating and that.
Okay, wait, no. There was cheating? You're suggesting
there was a suggestion of cheating, and it was just
they checked his ears.
They checked his ears, but it was in the 6th inning, so there was time for it to wear off. Heard all about it last time.
You're suggesting, or your children are suggesting?
My children. I'm not suggesting. I'm not an expert in it.
Okay, so he was pitching so well. All the Mets fans assume he was cheating.
I mean, my children maybe account for all the Mets fans, but I'm not an expert in it.
We're allowing the view of 10-year-olds to shape the narrative on baseball this
and
morning.
13, a 10-year-old and a 13-year-old.
That's good. That's encouraging. Can they do the markets too?
Actually, maybe.
David Riley the next hour.
Better than me.
From Blue Bay Asset Management. You and I both. Futures negative from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Russia hit Kyiv and other Ukrainian cities today in what appeared to be the most intense missile barrage since the opening days of the war. Infrastructure facilities in 8 regions were hit. The attacks came after Vladimir Putin blamed Ukraine for an explosion on a key bridge link between the Russian mainland and Crimea. Ukraine hasn't claimed responsibility, but within hours it commemorated the blast with a new postage stamp. In the UK, Chancellor of the Exchequer Kwasi Kwarteng is taking steps to calm financial markets following a turbulent period. Kwarteng will announce his medium-term fiscal strategy and economic forecast on October 31st. That's more than 3 weeks before he had originally planned. In Germany, an advisory group is urging the government to subsidize as much as 80% of natural gas consumption for households and companies early next year. It would be a part of a $194 billion aid package. The German government will review the recommendations and issue a decision in the coming weeks. Former Federal Reserve Chair Ben Bernanke is one of 3 people to share this year's Nobel Prize in Economics. Bernanke, Douglas Diamond, and Philip Dybvig were honored for their research on banks and economic crises. The 3 will share a $900,000 award. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city, it's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. This is all money in. This is me just building.
It's pretty much full-service shadow banking with nobody in charge.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Bloomberg has the biggest names in business. First, from the Greenwich Economic Forum in Connecticut, a global perspective on alternative investments with influencers from politics and finance. Then, Bloomberg Invest New York, where industry leaders discuss the challenges and opportunities in today's changing economic landscape. Coverage begins tomorrow, only on Bloomberg, your global business authority.
Even Chair Powell has gone from looking for a soft landing to a softish landing to now talking about pain. And that is the problem. That is the cost of a Federal Reserve being late. Not only does it have to overcome inflation, but it has to restore its credibility. So yes, I fear that we risk a very high probability of a damaging recession that was totally avoidable.
Mohammed Al-Arian, Bloomberg opinion columnist and president of Queen's College, Cambridge, on CBS over the weekend, and New York Mets fan as well. Loves the Jets too, and the Jets actually won over the weekend.
Yeah, they did.
So that's the good news.
Right. The bad news is that my kids are Giants fans, as he asked me.
Oh, they're
whether
Giant
they
fans,
have, yeah.
okay.
So they don't have any potential win. His comments, though, were really fascinating over the weekend. His comments are always fascinating. But
great.
Basically saying how avoidable this was, that the Fed made an error that is going to be incredibly painful to potentially remedy. And that's the reason why I pushed back a little bit about the politicization of prior Fed officials. As you said very rightly, John, we have not seen the legacy of this particular policy with respect to monetary easing and quantitative easing. It's just not clear what the legacy will actually be.
Two mistakes for a lot of people. The first one is that they were late, and the second one is that they might overdo it. And that's the problem so many people have. Every research piece that I read after Friday's jobs report just said 75 basis points now done. Here we go again.
And people saying that the JOLTS report indicates a pretty quick cooling. So at what point is there this push-pull of acknowledging the weakening data, or at least the weakening around the edges in an economy that could allow the Fed to move a little more slowly? But they don't want to make the same mistake, so they're going to keep their pedal on the gas in terms of how quickly they decelerate this economy.
Can we talk about the UK briefly?
Sure.
Bringing forward its fiscal announcement to the end of this month alongside the OBR forecast as well. Halloween. Who scheduled it for Halloween? I'm sure they've got a good reason for it, but can you imagine what the front pages of the newspapers are going to look like.
Yeah, spooky.
What is wrong with these communications departments of these governments? I just don't get it at all.
I can't. I'm not an expert in it.
It doesn't make sense to me.
I'm just going to keep using that over and over again because I think it's perfect for today.
Not an expert in it either, but that just seems ridiculous.
It's ridiculous. And honestly, bringing it forward is spooky enough for the markets because clearly they're going to basically be caving to what the market is saying. But second of all, to wait that long and then to wait for that day, I mean, they're basically just setting themselves up for ridicule.
You're going to do boo the whole hour?
Boo.
It's not scary at all. AMH down in DC, our Bloomberg Washington correspondent joins us now. Anne-Marie, what dreadful pictures over the weekend in Ukraine, through Crimea. What's going on now, AMH, and how is this administration responding?
It's incredibly dreadful and devastating. The pictures coming out of Ukraine, especially this morning, Jonathan, Kyiv. This is a lot of civilians that are being targeted by these missile strikes. We don't have a statement yet from the administration on what we're seeing just newly this morning from the ground in Ukraine. But what we can expect, according to President Zelensky, who's been working the phones, he recently this morning was on the phone with German Chancellor Olaf Scholz. Germany holds the presidency of the G7 meeting. It does seem like there will be an urgent gathering virtually of these leaders and how they're going to respond. What you can expect the Ukrainians are going to ask for, obviously, is more weapons. Maybe now what we're seeing, they'll ask for potentially another no-fly zone. This is something we haven't really heard about, but this was a huge target for the Ukrainians and a goal of theirs and an aim of theirs to ask for when the war first began, of course, back in February.
Anne-Marie, what counts as a major escalation in this war, and why does it matter?
It's a great question. I think at this moment, what we've been talking about in terms of a major escalation was the fact that Putin, of course, had been brandishing the idea of using nuclear weapons. And we've heard over the weekend from the National Security Council's Admiral General Kirby, who's their spokesperson, talking about the fact that there would be severe consequences if Putin were to do this. But what it does look like you're seeing now on the ground is almost a tit for tat. Putin has said that it was the Ukrainians that blew up this bridge, a blast on the bridge that connects Russia to Crimea. We should note that this bridge is incredibly important to Putin, not just tactically for Russia in terms of getting supplies to his troops in Crimea, but also personally. In 2016, he said, this is a historical mission for Russia. It was a dream of his to unite Russia with Crimea. And then in 2018, when that bridge opened, he personally opened it by driving a truck down that bridge. And then what do you have 2 days later? A barrage that we have not seen since the beginning of this war on Kiev. And also the fact that Putin has now put in place a single general of his operation. And this is a general that led Russian troops in Syria when they absolutely destroyed Aleppo. So you can imagine the scenes that may be coming out of Ukraine in the next few days.
Anne-Marie, just a final word on OPEC, if we can. Guest after guest over the weekend and over the last week that came from the administration on various networks, including on this one, on TV and radio, said the same thing. They're disappointed in OPEC. What options do they actually have?
Well, they definitely are disappointed. You're 4 weeks out from the midterm elections, and gas prices still remain top of voters' minds. There's not a lot they can do unless they want to tap the SPR again. But remember, the SPR right now, we're at stocks as low as from the 1980s. But Jonathan, politically, you already see Ro Khanna and also Senator Blumenthal writing last night in Politico an opinion piece that they are going to offer bicameral legislation to stop immediately U.S. arms sales to Saudi Arabia. So potentially the response may be towards Saudi Arabia in particular, and less so the U.S. has a lot of weight right now in terms of oil. There's also the Wall Street Journal reporting maybe that they'll lift some sanctions on Venezuela. So it does seem that they have a few tools to use, but they're probably not what they wanted as their first primary tool in the toolbox.
MH, thank you. Anne-Marie, down in D.C., Brent crude right now, 97.31. Still haven't fully realised the fallout from last week, have we? On the oil front at all, Lisa?
Both from a market perspective as well as from a political perspective, right? Anne-Marie talking about a possible repercussions for Saudi Arabia from the United States. My question is why? We haven't necessarily seen a price surge in crude. There is a question about whether there is some reality to the decline in demand that we have not necessarily seen yet. But is this also the alliance with Russia, right? The sort of discussion of the possible caps on the oil prices as being enough of an inconvenience or an uncertainty that would necessitate this kind of action. And I wonder how much that's sort of playing into the backdrop here.
If you strip out the politics, I know it's tremendously difficult to do that, but if you are the cartel, OPEC Plus, I'm sure they love to call themselves that. If you are OPEC Plus and you're looking at all these warnings about decelerating economic growth in the United States and worldwide, then does it make sense to pull back on output? And perhaps it does if you don't have much spare capacity.
Well, but that's the key issue. The spare capacity, how much is that the real story, and actually speaks to much higher prices regardless of what they say in terms of their output targets. They just don't have the ability to pump it, and they want to save it for when there is really a necessary circumstance.
Futures on the S&P 500 this morning, slightly negative. Live from New York, this is Bloomberg.
Stronger that moment that you're lifting the barbell, you get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Live Live from New York City this morning. Good morning to you all. Here's the price action this Monday morning on the S&P 500. Slightly negative through much of the day so far. On the S&P, we're down 1/3 of 1%. On the Nasdaq, we're down 1/2 of 1%. Last week, even with the 3 days of losses to end the week, still just about managed to grind out a week of gains. In the bond market, treasuries are closed for Columbus Day. We'll have a look at the German bond market for you. 2s, 10s and 30s. Yields unchanged on a German 10-year at about 2.19 over the last 10 weeks. Yields have been climbing higher on a German 10-year. We have gone from about 82 basis points 10 weeks ago to more than 2% right now. And I have to tell you, the Italian 10-year, 474, and the spread between the German and the Italian 10-year at the wides of the year now, Lisa, 255. Got to go back to 2020 for a level bigger than that.
And people are expecting a 75 basis point rate hike from the ECB at their next meeting. This really just shows how dramatic the turnaround has been. We're basically making the negative yielding regime extinct, save for what's happening in Japan. And that's a huge about face considering where we were just a year ago.
Is the euro starting to trade on spreads? Take a look at euro dollar. Euro dollar negative by 0.4 of 1%, just about holding on to 97. Lisa, do you think spreads are starting to matter for the single currency going into the ECB in a couple of weeks?
They have to, because if the ECB is concerned about financial stability in Italy, in closing that spread, that gap, then perhaps they won't be as aggressive in terms of how much they tighten, which would be not necessarily supportive maybe for the euro. But again, what does the ECB have, what effect do they have on yields right now, based on the idea that a lot of it's trading on the economic prospects the more the ECB hikes, while previously perhaps bullish for the euro might not be if that means weaker growth going forward.
Italy might have a problem in the weeks to come. The UK's got one already. Danny Berger joins us now out of London. Danny, walk us through the latest moves from the Bank of England to do something about this bond market.
Yeah, I've been trying to think of the analogy for this, and I think I've got it, John, but it might be a little bit sloppy. Essentially, the BOE is just like pouring in an entire bottle of booze into the punch bowl just before taking it away. So we're still getting the end of this long-term bond buying program on Friday, but they've doubled the amount of this daily auction. The problem is does that stop this pension doom loop if nobody uses it? And no one has really been using it. I mean, people have, but the maximum has been $40 billion. They've only bought 5 billion pounds, I should say, pounds worth of debt, although dollar, pound, basically the same now. So there's that issue. Perhaps the more interesting thing they've done then is put this new short-term funding facility into the works. It's set to expire, at least for now, on November 10th. So that allows banks to draw down more cash, put up collateral that also could take the form of corporate bonds, again, in this effort to get that cash instead of having to do a fire sale, thus creating this doom loop we've seen.
Do we have a better sequence of events on a calendar now, with October 31 being the date in the diary for the fiscal event, and then November 3rd, the Bank of England?
Well, I mean, October 31st is also the day that QT is supposed to start. So it's still an extremely difficult calendar. If we get the BOE, they stop buying bonds this Friday. Come the 31st, yes, there's more calm, there's more hope, considering that the OBR budget has been moved up to the 31st, the fiscal event moved there as well. But again, it could be a day of extreme volatility if the BOE is starting to do QT on the same day. We're going to get this budget with still lots of question marks surrounding it.
Danny, how much pressure is there to move the budget up yet again to October 16th or October 14th, around the time of this expiration of the current bond purchasing program?
I mean, huge pressure, considering it is a bond market that continues to sell off. We've seen the long end of the curve retrace about half of the rally we saw since the BOE stepped in. It is a market that is extremely still worried about what happens after Friday. If they have to wait until the 31st for both QT and that budget, again, I go back to this, it's still a very challenging timeline. And considering Kwasi Kwarteng is in D.C., meeting with other central bank chiefs, meeting with the IMF, who has criticized them, the pressure is going to be on.
Danny, thank you. Wonderful as always. Danny Berger out of London here from Bloomberg. The 10-year gilt yield up by around about 10 basis points. Lisa, the 30-year up by 14.
This hasn't necessarily ended the crisis in some of the pensions. And a lot of people are talking about how there is a massive trade that's still being unwound with some of the pensions that tried to match their liabilities and hedge out risk that are being upended. How much they can do this at an easy pace, right? Because it's not about staving off the declines in some of these long bond prices. It's about how do you control it from a financial stability standpoint. I don't understand the difference completely.
Marcus Ashworth, my Bloomberg opinion columnist, joins us right now. Marcus, your thoughts on what we got from the Bank of England earlier today?
Well, I think that was a necessary move. I don't see any cliff edge. I'm not quite sure I totally agree with what Danny's saying there, but certainly it's not the party I'd want to go to, because they've increased the amount that they're going to buy, but that's just a nominal thing. I don't think we'll see anything like 10 billion or even 5 billion. As you did point out, the Bank of England's only bought 5 billion so far throughout, over half the process. I think they're just trying to assuage as many people as possible that they're on top of it with regards to people needing to sell. They're a backstop bid there. They're not in the mid as it were starting. They've sorted out the gaming of it, with a lot of hedge funds probably piling in. They're now adding out a repo facility for at least another month so people can put in corporate bonds or other things rather than just gilts. They're doing their best. However, October 31, what an odd date for the government to put on it, because it's right when not just active QT is supposed to start again, which must be delayed by the Bank of England. That's clearly right on their doorstep. They've landed that one. But at the same time, there's a big gilt auction that week, and only 3 or 4 days later, we got both the Fed and the Bank of England's decision on interest rates. It's a terrible week to start off, i.e. that October 31 had better be what the market wants from quasi-Quartain. Otherwise, we have a week of absolute nightmare.
Marcus, how much is the Bank of England setting the tone for what's going to happen at the European Central Bank, with backing away from perhaps quantitative tightening, or at least coming up with some quantitative buying in addition to quantitative letting it roll off?
I don't think the ECB will be taking much stock of what the Bank of England is doing, other than they know not to mess perhaps with quantitative tightening this year at least. They had a meeting last week where they started to think about talking about it, but I bet you they just pushed it off into as far as that long grass they possibly can. Do not touch quantitative tightening for the ECB must surely be the message the Bank of England has handed to them.
What's the difference right now, Marcus, between prices declining and a financial stability risk?
Well, that's very interesting. I think the US Fed needs to be paying much more attention with the volatility in the MOVE index. We can clearly see, and big active quantitative tightening coming down the pipe here from the Fed, that they've got to be very careful that conflating interest rate hikes at the same time as big quantitative tightening is an experiment we've never really seen before. And clearly, the very sensitive nature of the UK market, which everyone thought that was a safe, boring bit, shows you that this is a very, very difficult situation to do at the same time. And I hope they understand that the financial stability is just as part of their mandate is controlling inflation.
Marcus, you said something interesting a few minutes ago. You said they better bring what the market wants to see. Marcus, what do you think the market actually wants to see from the Chancellor?
Well, they want to see some funded spending and indeed cuts to what exactly they expect over a 3-year, and probably more likely he's going to extend it, I think, to 5 years, as to how they're going to balance the budget. Can the numbers add up, and are they believable? I mean, at one stroke, you could cancel a thing called HS2, a big railway line for £100 billion. That would solve their problem, but that causes bigger problems elsewhere. You can't just cut health spending. You can't just cancel or keep welfare benefits on a lower level. They've got to do something which is sustainable and show that all the numbers with their large borrowing they want to do, not just this year, much more importantly, next year as well. Huge borrowing expected next year for the Bank of England. That's the real reason why gilts are worried at the moment. And I think they need to have an ability to show that they have spending plans which make sense with their debt raising.
Marcus, some of the announcements that the Chancellor made a number of Fridays ago have been widely ridiculed. I just wonder how many people in about 12 months' time will actually be pushing for some of these initiatives again, Marcus, because the economy is going to roll over.
Well, this is the irony. I mean, some of the stuff that he suggested would have been great perhaps in a year's time, once they've got put their homework clearly out for everyone to see how everything's going to make sense, and their priorities were, I think, about face. But there are a lot more things that need to be done. Some of the things that they've reversed, particularly Rishi Sunak's corporate tax hikes and obviously the national insurance raise, make sense. But I mean, I equally think they've got to bring everyone along with them. And it's the whole presentation of what was could have been a good plan was completely misguided, and that, unfortunately, they're paying the price for. Don't mess with the bond markets, John.
Don't mess with the bond market. Is that the message to Italy as well?
Most certainly, and they've got to worry. They've got something like 250 billion to refinance next year, with interest rates now up from what 1.5 to maybe 4.5. Their cost is going through the roof. So yes, very much Italy has to pay very close attention to how you finance yourself, and bond markets need a bit of respect.
475. You said it, Marcus. Thank you, Marcus Ashworth. I think we all respect the bond market after the moves of the last couple of weeks, the moves of the last 12 months. 475 on an Italian 10-year. The spread's the widest of the year so far versus Germany. That's a significant move.
Especially at a time when you have a government that wants to do more and spend more, but is constrained by not only the European Commission and what their terms are, but also with respect to the bond market. Right now, the bond market's saying you don't have a lot of leeway to borrow more.
When does the ECB look to do something about this in a bigger way?
That's the reason why I asked this question. I mean, the Bank of England, perhaps they're not looking at that situation as completely analogous. However, there is this issue that you cannot engage in quantitative tightening. And do you get, this is something we've been talking about extensively, do you get quantitative easing and monetary policy tightening?
It's bizarre.
But what is the other option right now? And that's what we heard about, these ideas of targeted buying. What's the political ramification for targeted buying of Italian bonds? Does Italy actually have more leeway because of what Germany is doing right now with some of their borrowing and what's going on with their energy situation?
Andrew Balls of PIMCO is going to join me a little bit later at 9:30 Eastern Time around the opening bell. PIMCO always talk about maintaining some dry powder, being liquidity providers in times of stress, not liquidity demanders. I wonder if they've been buying gilts over the last month. I wonder if they've stepped in to buy Italy yet.
Do you catch a falling knife? I guess that just keeps resounding in my head because right now it has been a falling knife.
But if you stepped into gilts when they gapped out, you've done pretty well, haven't you?
For now, although it depends on what kind of policy response there can be and what kind of proverbial margin calls there are around the world, something that I was reading a bit about over the weekend.
Giving away my line of questioning to Andrew, if you watch